I request everybody to settle down and take their seats. We'll be starting with the conference very shortly. Small request to all of you to please put your phones on silent so that there are no interruptions when the speakers are speaking. We'll start very shortly. Request all of you to please settle down and take your seats. If your friends are outside or they're on the way, give them a call, ask them to hurry up. Come and settle down because we'll be starting very shortly, and we are looking forward to your inputs, to your feedback, to your questions. So request all of you to please listen attentively when we have the host of our dignitaries coming up, important people. They will bring in a lot of clarity today. All we request is your attention and no distractions, so please put your phones on silent. Good morning. I would request all of you to please take your seats and settle down. We will start the program in a couple of minutes. So I request all of you to please clear the aisles and take your seats. Special post-budget conference on analysis of tax-related proposals. Please put your hands together and give a rousing welcome to our esteemed dignitaries of the inaugural session who are making their way onto the stage. Please welcome our chief guest, Mr. Tuhin Kant Pandey, Finance Secretary and Secretary, Department of Revenue, Ministry of Finance. Mr. Ravi Agarwal, Chairman, Central Board of Direct Taxes, CBDT, Ministry of Finance. Mr. Sanjay Kumar Agarwal, Chairman, Central Board of Indirect Taxes and Customs, CBIC, Ministry of Finance. Mr. Manish Singhal, Secretary General, ASSOCHAM. Mr. Sandeep Chofla, Chairman, National Council on Direct Taxes, ASSOCHAM. Mr. Rakesh Nangia, Chairman, International Tax Council, ASSOCHAM, and Mr. Atul Puri, Co-Chairman, International Tax Council, ASSOCHAM. We are very honored and privileged to have our esteemed dignitaries joining us. I would request Mr. Manish Singhal to please welcome our chief guest, Mr. Tuhin Kant Pandey, Finance Secretary and Secretary, Department of Revenue, Ministry of Finance, with a plant for gracing us with his presence. Please give him a round of applause. We are grateful to him for taking the time to come here and give more clarity on the tax proposals in the budget. I would request Mr. Sandeep Chofla to please welcome our special guest, Mr. Ravi Agarwal, Chairman, Central Board of Direct Taxes, CBDT, Ministry of Finance. Thank you, sir, for your presence here. I would request Mr. Rakesh Nangia to please present a plant to Mr. Sanjay Kumar Agarwal, Chairman, Central Board of Indirect Taxes and Customs, CBIC, Ministry of Finance. Thank you, sir, for taking the time to come here. Today, we will analyze the implication of the budget's tax proposals during the day today. I would request Mr. Manish Singhal, Secretary General, ASSOCHAM, to please give the opening address. Please put your hands together for Mr. Manish Singhal.
Good morning, everybody. Thanks for joining us here today. Special welcome to Shri Tuhin Kant Pandey, Finance Secretary and Secretary, Department of Revenue, Ministry of Finance. Shri Sanjay Kumar Agarwal, Chairman, CBIC. Shri Ravi Agarwal, Chairman, CBDT. Shri Sandeep Chofla, Chairman of National Council on Direct Taxes for ASSOCHAM. Shri Rakesh Nangia, Chairman, International Tax Council of ASSOCHAM, and Shri Atul Puri, Co-Chairman, International Tax Council, ASSOCHAM. All the revered guests and people on the dais, off the dais. I think 2025, when it starts, all of us have expectations, resolutions. Now, I don't know whether President Trump has been meeting expectations or not, but surely I think Indian government has been meeting a lot of expectations. So with that, I think we had a fairly, I would say, outlier budget, which because it more than met expectations and probably delighted many people. But like all budgets, since there has to be a very tightrope walking, it's not a cakewalk at all for the finance ministry or the finance minister. There will be a lot of expectations met and a lot of expectations which are also not met. At the end of the day, to maintain a fiscal discipline like the finance minister has done, it's very difficult to, let's say, keep everyone happy. But I think most of us are happy. I think shorten the arm given by the finance minister with the income tax relief to our large 400, 500 million middle class. I think that's a very big thing, not only as a relief for the middle class, but the way it will rev up the economic engine. Because let's all realize, you all would realize that this extra money will either go a little bit into savings or it will go into consumption. And when consumption happens, that's where the private sector capex will come in. So we should well look forward to our economy going towards our aspirational growth rate of 8% with all this. And of course, the government has continued with the infrastructure push, the benefits or the support to the social sectors, and of course the sustainability push with more investments into nuclear energy, the small nuclear plants. So all that should add up to really boost the economy going forward. At the same time, I think like our finance minister mentioned, there was also a lot of emphasis both in the economic survey and in the budget on ease of doing business. So that means the government has been cognizant of the fact that ease of doing business, especially what the economic advisor said, deregulation at the state level, those are the things which are going to further support the industry to really focus on business growth and economic growth, and keeping fears of criminalization laws and others behind them, and just focus on investment and economic boost. We are expecting the new income tax bill, so I'm not sure whether the secretary will let the cat out of the bag as yet. But yes, a lot of the broad areas we are expecting are already highlighted in the budget. So I think today we have an excellent opportunity for you all to interact with the team from the finance ministry. Before I sign off, I would also want Secretary to delve into FM's statement that the Prime Minister was more than happy when she proposed the income tax relief for the middle class, but the bureaucracy took time. Now I am sure the bureaucracy took time because, like I said, it's a tightrope walk. If you could also, Secretary Sir, explain as to what's the math which will get us to the fiscal discipline, the 4.4% target we've taken, with reduced revenues on income tax front, on customs front. There is a marginal increase on infrastructure allocation. So how does the math work so that we maintain the fiscal discipline and yet offer all the support which this landmark budget gives? So looking forward to an exciting session, not only this inaugural one, but even the two sessions which follow today. Thank you so much.
Thank you so much, sir. I would now request Mr. Sandeep Chofla, Chairman, National Council on Direct Taxes, ASSOCHAM, to please address the audience. Please put your hands together for Mr. Chofla.
Thank you, Manish ji. Shri Tuhin Kanta Pandey, Finance Secretary and Secretary, Department Revenue, Ministry of Finance. Shri Ravi Agarwal ji, Chairman, CBDT, Ministry of Finance. Shri Sanjay Kumar Agarwal, Chairman, CBIC, Ministry of Finance. Other dignitaries from the Government of India, my panelists and the speakers for the conference today, I welcome you all on behalf of ASSOCHAM to this post-budget conference, which is always an interesting post-budget discussion. I've seen over the years, once the budget is announced, and then people go through the fine print, and there are always nuances, there are aspects that we as tax professionals and chartered accountants and lawyers, we would go through the fine print clause by clause. So there is always a scope for discussion and deliberation. I hope that this Finance Bill 2025 will not be any exception. Now, as Manish ji said, as a prelude, the Honorable Finance Minister presented the budget where the growth rate for FY25 is relatively lower than what is expected, about 6.4. And as the economic survey said, the growth rate for the next 2 years also is going to be, or the next year is going to be in the range of 6.3 to 6.8%. Whereas, in order to realize our vision for Viksit Bharat 2047, the growth rate has to be an annually consistent growth rate of 8%. So therefore, there's a lot of things that need to be done. Global headwinds are there, geopolitical changes. Manish ji referred to Trump 2.0 administration. So those aspects are there. So therefore, the Honorable Finance Minister had a very difficult task of trying to reinvigorate the growth, propel the economy. At the same time, there are these counterintuitive factors which are there which need to be kept in mind. There has been a slowing demand and consumption. So therefore, one of the key aspects of the budget was how to boost the consumption. So therefore, there are a slew of measures announced by the Honorable Finance Minister on the policy front, whether it is on the regulatory changes, the new manufacturing mission, the export policy, center of excellence, infrastructure development, and many more. I will not get into details on that because the conference is on discussion on the tax-related proposals in the finance bill, but I must lay the foundation for that. And I was really very much happy to see that the policy announcements made by the Honorable Finance Minister, how the alignment of those policies have been done in the income tax and the other tax proposals, which otherwise, at many a times one found that whereas the policy proposals is there, but the tax proposals are more on the reform side, etc. But here, in this finance bill, you would see that the tax changes are getting aligned to what the various policy announcement the finance minister is. And therefore, if one were to look at, and clearly, it again reinforces the tax policy is one of the very critical fiscal policy measures that is adopted by economists, and there is a true reflection of that coming out in the finance bill. Now, some of the changes, and I will not go into much detail because there are panel discussions during the day, and you will have interaction with a lot of panelists and speakers and everyone on that. But something that needs to be looked at, if you look at the tax policy, there is a consistency. Corporate tax rates have remained unchanged for almost 5 years, because this is one very big aspect that any investor, anyone, or whether domestic or foreign, looks at. That is there a certainty in the tax rate? The answer is yes. Now, then it comes to the middle class individuals, where clearly the finance minister recognized that the middle class, they are nation builders, and therefore there has to be relief to them, substantial tax relief. It is like unprecedented. The tax slabs which have been rationalized, the tax rebate which has been enhanced, resulting in a huge tax relief to the middle class. And therefore, this is certainly going to boost the consumption and spur investment in the economy. The other is that if you look at the announcement on the new income tax bill, which will be tabled in the parliament in a week's time. So again, a measure towards simplification, reducing uncertainty and reducing the tax litigation. Rationalization of TCS and TDS provisions, increasing the thresholds again, helping the small businesses, reducing their tax compliance burden. The other aspect, if you look at, is building trust. And clearly, as the Honorable Finance Minister said, that we have ears to the ground, we have, we know the pulse, and we are responding. And how did they respond? If you look at enhancing the time limit for updated tax return, again, giving an opportunity that, okay, if you have missed out, then with some additional taxes, file your updated tax returns. Introduction of block assessment for transfer pricing, again, in line with the international tax principles, that if you have similar transactions and you opt for that, and if it is agreeable to the transfer pricing officer, then the arm's length price, which is agreed in year 1, would be applicable even for year 2 and year 3. Again, a landmark step, I would say. Safe harbor rules, again, are going to be rules. There is going to be extension. Lot more items are going to be included in safe harbor, again, gearing towards tax certainty and reducing litigation. Now coming to growth and investment, again, in line with all the policy announcement of the Honorable Finance Minister. Tax holiday for startup, the sunset was 31st March. You need to be incorporated by 31st March 25, extended by 5 years. International Financial Services Center, lot of amendments are there. The scope of the services has been increased. Treasury centers and your ship leasing, etc. And again, on many of these, the sunset clause has been extended by 5 years. So I think in light of all of this, and this again is unprecedented. Earlier, the sunset clause used to be extended by just a year or so. 5 years, that means the government is listening. They understand that the industry needs time to, align their business models. There is a time for setting up, and therefore given a 5-year tax period. And as I said, that, lot that will be discussed in the panel discussions today, and therefore I will not dwell much further on this, and request the audience to listen to the next speaker. And also, on the custom side, though I am not a custom expert, the way the inverted duty structure has been tried to be aligned, giving again fillip to the Make in India is again a very welcome step. So thank you very much, and inviting the next speaker. Thank you.
Thank you, sir. I would now request Mr. Rakesh Nangia, Chairman, International Tax Council, ASSOCHAM, to please address the audience.
Good morning, everyone. Shri Tuhin Kanta Pandey ji, Finance Secretary and Secretary, Department of Revenue, Ravi Agarwal ji, Chairman, Central Board of Direct Taxes, and Sanjay Kumar Agarwal ji, Chairman, Central Board of Indirect Taxes. And Budget 2025 looks likely, with the immediate an historic budget, a game changer, a blockbuster reforms announced on corporate, on personal income tax, unprecedented, never seen in the past, hopefully since independence. Hopefully it will not give any inflationary push, and Indian Inc. is likely to be partner in this reform push. Presenting this 8th consecutive budget, the Finance Minister, she said, this budget continues our government efforts to accelerate growth, to secure inclusive development, invigorate private investment, uplift household sentiments, and enhance spending power of India's rising middle class. This budget hopefully aims to initiate some transformative reforms, especially on the 6 domains which the FM mentioned. One was, the chief was taxation, power sector, urban development, mining, financial sector, and regulatory reforms. Further, FM announced various measures for MSMEs and calling them the second engine. The core of the country today in the business is MSME. The maximum part of the GDP contributed in this country is by MSME, and it's the first in the time lately There is a massive impetus by the government in terms of policy matter, finance matter, giving them funding actually, a massive dose which has been given to MSMEs. She also proposed a new fund. This is something very interesting I would like to share with you for the startup. And you won't believe it, this is the second scheme which has come, if I'm not mistaken. The first scheme which came, where the 10,000 crores, I was told has gone up to 9x. That investment has become 9x. See the advantage, see the multiple. 10,000 crores investment has become 90,000 crores, and there's another 10,000 crores commitment by the government in this budget. Another 20,000 crore investment to drive private sector on research, development, and innovation could be a game changer. India deep tech ecosystem will spring up like this. More important, if you see this, FM proposes to rationalize the requirement and procedures for speedy approval of company mergers. A very big change, basically. A reformist thing, basically, which the government has announced is fast-track mergers, simplify the process. Very well acknowledged. And FM lays down 4 specific measures to shape regulatory reform, setting up a high-level committee for regulatory reforms, launch an investment friendliness index of states, establishment of a financial development council, and the Jan Vishwas Bill 2 to decriminalize more than 100 provisions of laws. So I have one point here. India has 26,000 criminal laws. Last government has made a massive removal, decriminalized budget. The 100 numbers in terms of this looks very lesser. I think a high penalty is a bigger deterrent. This actually is a retarded thing, sir. So maybe a very small request, if more cases can be decriminalized, which are desired. They will be levied taxes, that they have to pay the price for that. But that would be could be considered by, so 100 looks very small number, see that is concerned. So, and FM, she mentions, our economy is the fastest growing among all major global economies in the world. Our development track record for the past 10 years, structural reforms have drawn global attention. We see the next 5 years as a unique opportunity to realize Sabka Vikas, stimulating balanced growth for all the regions. And this budget is expected to fuel consumption, investment, and 1 lakh crore being released actually as additional money in the hand of middle class will have a cascading multiple effect for the benefit of the economy, for the manufacturing sector, for the traders, for the real estate, for the whole ecosystem actually. So that's where we are with the budget. At a first glance, it seems clear: growth, investment, a dash of tax relief, very good. But as you deeper you go, and the more choices pops up, making you wonder, was it a bold economic move or was it a safe bet? We'll dive in as we go and discuss today. The government is actually betting a lot on consumption to revive economic growth instead of splurging on public capital expenditure. And this is the first time we have seen where the capex expenditure has been more or less same what was there last year. We are going to discuss this thing. I've got a lot of facts and figures to share with you basically. One of the items missing in the budget menu are a roadmap for second generation reform and a commitment for strategic divestment. And expenditure of capex at the same level I just mentioned is baffling. Very less for the first time infrastructure has been said on the budget speech. Very surprising, sir. We have 11 lakh crore last year. This year is 13 lakh crore. But the mention in the budget speech, the budget speech used to be loaded with road structures, road, ports, aircraft, everything. But less has been mentioned on the, and the incremental is only 5% on the infrastructure budget, sir. So without deeper funding for health, education, skilling is a feast which is missing in the most important ingredient. I say I leave for the expert and sir to share on this matter why it is so. So let's stay tuned. Let's see where this union budget takes us basically. But it looks likely to be a safe, predictable, or it will be a riskier or more rewarding order. Thank you so much.
Thank you, sir. I would now request Mr. Sanjay Kumar Agarwal, Chairman, Central Board of Indirect Taxes and Customs, CBIC, Ministry of Finance, to please address the audience. Please give a round of applause to Mr. Sanjay Kumar Agarwal.
Finance Secretary Shri Tuhin Kant Pandey ji, Chairman CBDT Shri Ravi Agrawal, Shri Manish Singhal, Secretary General SOCHM, Mr. Sandeep Chawla, Chairman National Council on Indirect Taxes SOCHM, Mr. Rakesh Nangia, Chairman International Tax Council SOCHM, other dignitaries, delegates, ladies and gentlemen. I am delighted to join in this post-budget seminar of SOCHM, and I would like to share some insights and the thought process which has gone into making the proposals on custom side. Let me begin with the exercise which has been conducted on customs duty rate rationalization as announced by Honorable FM in July 2024 budget speech. The magnitude of that exercise is revealed from the fact that there are 12,500 tariff lines, and this exercise has been conducted in respect of 8,500 tariff lines which are pertaining to industrial goods. We have not touched agriculture goods and textiles, which are very sensitive in nature and require frequent calibration depending upon how the harvest take place in the country. So we have gone line by line. We have seen the different tax slabs, and the objective for conducting this exercise was to simplify the rate structure, ensuring economic competitiveness of the Indian industry. Then, wherever some higher degree of protection is to be provided to the industry for a short duration, that was also kept in mind, and how to provide ease of doing business, that was the fourth objective. With these objectives in mind, the rate structure was looked into. We had 15 tax rates, but we found that most of the items were placed in rates between 0 to 10%, between 0, 2.5, 5, 7.5 and 10, in a graded manner with distinctive stage in the value chain. And the items like raw materials, minerals are placed at 0, 0 or 2.5. The intermediate goods, which emerges after certain processing of raw materials, were placed at 7, 7.5, capital goods at 7.5, and finished goods at 10. We found that this structure has remained unchanged for almost 2 decades. It's a very settled rate structure on these items, and therefore for policy continuity and certainty, these rates have not been touched. Items have remained where they are. Rates at 15 and 20%, the items which are placed in these rates are mostly which are covered under PLI or PMP schemes for Make in India program of Government of India, and therefore these rates have not been touched. Items remain where they are. But in this exercise, we have found that there is an optic or a narration that India has very high rates. We found that the highest rate is 150% for industrial goods, and there is a single item on that rate, whereas the effective rate on that item is much lower. And the rate has been capped because it was noticed that there is circumvention of payment of duty on ethyl alcohol coming as laboratory chemical. There is no need to keep that rate. Similarly, the second highest rate was 125%. And there was again a single item on that. Tariff lines may be more associated with that particular item, that is passenger car. 100%, again there are 3 items. Motorcycles, baggage, and synthetic odoriferous substances, which is a raw material, industrial raw material. There was no need to keep it at such a high rate, so it was brought down to 20% tariff rate. Other items have been brought down to 70%. Similarly, 40%, again three items, which were solar modules, and the other item is buses and trucks. Third item is goods imported for personal use. So there were very few items. So it was thought that again we can do some rejig, kept the rates intact in case of marble and granite blocks, but slightly reduced for buses, trucks, and for the last item. Similarly, at 35% also, there were very few items, 3 items. For 30%, again 3 items. 25%, 4-5 items. So we were unnecessarily attracting bad optics. So all these rates have been now brought down to 20%, which were between 70 to 20%, and those which were above 70% have been brought down to 70%. But we also ensured that industry is not hit badly. The process has to be gradual, and therefore equivalent amount of AIDC has been imposed to keep the rates effective duty incidence at the same rate or slightly lower rate, so that shock is absorbed gradually. But now the identification has been done. We know that where we have to work further to bring down the rates, to keep the industry competitive, keep the rates at such a level that it provides effective protection to the industry, but should not be too high to make the industry inefficient. So these were the objectives which were kept in this rate rationalization exercise. In addition to that, for simplification, it has been decided that items should not attract both cess and surcharge, and accordingly on 82 tariff lines, surcharge has been exempted. And wherever we found that the effective rate is not tariffized, is not there in the tariff, and it can be tariffized, so that 2 references, one to tariff, other to notification, need not to be made. So that exercise has also been conducted. This is broadly on the rate rationalization exercise, but in budget, the emphasis was, or in the budget proposal for reaching the customs duty was mainly on count of, we wanted to ensure that it should encourage domestic manufacturing and value addition, promote exports, facilitate trade, and provide relief to the common man. According to the proposals like exemption to customs duty on life-saving drugs, similarly bringing certain capital goods which are used for manufacturing of lithium-ion cells for batteries of EVs or mobile phones, or the textile shuttle-less loom for manufacturing of textile fabrics, or certain inputs for sub-inputs for manufacturing of the parts of the mobile phones were also exempted. For export promotion on handicrafts, on fish-based analog products, again certain measures have been taken. One important thing which has been done is to bring down the duty on critical mineral waste to nil. And this exercise is done because we have National Critical Mineral Mission. In that, recycling facilities are being established, and these critical minerals are very important for the manufacture of semiconductors, for renewable energy items, or for our space programs. And this reprocessing of waste is also considered as urban mining of such minerals, which are very critical for the economic growth of India. So these was on the part of the tax structure. But important thing which has been done is certain amendments have been made in the Customs Act, new provisions have been added. One is that earlier there was no time limit of finalization of provisional assessment. Provisional assessment remained pending for indefinite period, and that was not good for the trade. They need certainty, they need finalization of their assessment in a time-bound manner. So a time limit of 2 years has been prescribed for completion of provisional assessment. Another notable feature which I would like to highlight has been made in the Customs Act by adding a new section is the voluntary declaration post clearance of the goods from customs charge. In case certain new material facts come to the notice of importer, then they can make this voluntary declaration, and in case any additional duty is to be paid, that can be paid along with interest without any penalty. However, this facility is not available in case audit or investigation proceedings have already been initiated by the department. It's a major simplification because in present system, they will have to approach the department, seek for amendment, and then make the payment. Similarly, in case they have made excess payment of duty, then the present procedure is that they have to go against their own self-assessed bill of entry before Commissioner Appeals, get a favorable order, then come back to the department, seek an amendment, then file a refund claim. A circuitous process which may take more than a year. By this new provision, now in case they have made any excess payment or duty in their self-assessed bill of entry, they can straightway file a declaration that will be treated as a refund application and will be dealt in the same manner as other refund applications are dealt with. Another important thing which has been brought in this budget is on IGCR, which are attached with end use to promote Make in India or for promoting export with export condition. That the time limit was 6 months, extendable by 3 months. So that has been extended to 1 year and extendable by 3 months, so that they need not to approach the department again and again, because at times in global supply chains, they have to import in quantities which they may be able to consume maybe on a longer period. So to provide them that competitiveness, this change has also been brought. For easing that compliances in IGCR provision, now there will be a quarterly statement in place of a monthly statement. Broadly, these changes have been brought in the budget. But in addition to that, I would like to mention that in the last budget, FM made another important announcement that the remaining process in customs, which are still to be digitalized, will be digitalized. We have done an identification exercise, identified all the processes which are yet not been digitalized, although most of the processes are already digitalized. So work has been done, some processes have been rolled out in digital form, some are in the process of being rolled out, so that exercise is also being undertaken in right earnest. I would like to say, in conclusion, that if we have to make the India very competitive in global value chain, all of us, government, trade bodies, and industry stakeholders have to work in tandem, hand in hand, so to identify the bottlenecks, implement the solutions, and capitalize on the emerging opportunities. Thank you.
Thank you, sir. I would now request Mr. Ravi Agarwal, Chairman, Central Board of Direct Taxes, CBDT, Ministry of Finance, to please address the audience. Please give a round of applause to Mr. Ravi Agarwal.
Finance Secretary and Revenue Secretary Shri Tuhin Kant Pandey ji, my colleague in the CBIC, Chairman CBIC Shri Sanjay Agarwal, Mr. Sandeep Chawla, Chairman Direct Taxes SOCHM, Shri Rakesh Nangia, Chairman International Tax Council SOCHM, Mr. Manish Singhal, Secretary General SOCHM, Mr. Atul Puri, Co-Chairman International Tax Council SOCHM, delegates, ladies and gentlemen. A very good morning to all of you. Well, first of all, let me thank you for giving us this opportunity to be here and present our thoughts. I would also like to thank you for all the compliments that you have bestowed on us for bringing smiles to the taxpayer community at large. You see, the approach of the tax department has changed over a period of time. It is not just about collecting taxes, it's just not about some figures of tax collection. It is about the philosophy that tax is basically a derivative of a part of the income, a portion of the income. So you generate income and then automatically taxes come. And that is only possible when economy grows, the sentiment grows, the positive sentiment is there. So with that philosophy, now one has to look at the taxes, not at just the numbers, growth, the percentage collection, and so on and so forth. And with that perspective, if we see the overall approach in this budget, the aspirations of this Viksit Bharat. The aspirations of Viksit Bharat is accelerate growth, inclusive development, private sector investments to boost, to encourage private sector investments, uplift household sentiments, enhance spending power of India's rising middle class. And that's what was at the back of the mind while suggesting amendments in the Direct Tax Act. You see, in a typical family of 2 earning members, if the 2 members are earning about 12 lakhs each, in the present tax slabs, it was about 1,60,000 that they would pay individually, right? The 2 persons in the family. Today they would be paying nil, so 1,60,000 is in the hands of the family as such. And that is a substantial amount to take a call as to how to spend that money through consumption. It may boost savings. It has different connotations. So with that perspective, this suggestion of change in the tax slabs and also rebates has been approached. The other is how to make it simple for the business to run business. Can we provide stability? And therefore, the elements of, you see, extending the deadlines by 5 years, concept of updated returns, rationalizing of TDS, CDS, TCS provisions, decriminalizing those provisions. All these are basically elements which actually point towards the ease of doing business. How do we facilitate ease of doing business? The third component is trust first. So the trust first is that we have the information, we show you the information, and then you rely on that information, you comply. And that's what is the new way in which we are going about doing the tax administration. Gone are those days when it was just asking questions only, that administration through asking questions. It is now changed, it is not now a non-intrusive tax administration, driven by technology, driven by data, backed by data, rule-based. And this is what we feel that would trigger more compliance on part of the taxpayer, and as a result, that would boost revenues, which would be put for the national growth. So in this budget, if we see, there are certain provisions specifically that I would like to point, which was the ask of the taxpayer, the industry. One was to rationalize the TDS, TCS rates. That has been done. It has been a fourfold, approach that we have taken. First is rationalizing the thresholds as regards TDS and TCS. The second is rationalizing the rates of the TDS and TCS. Third is decriminalizing the provisions. And fourth is, there were certain transactions where the taxpayers were finding it difficult to comply with the provisions as such. For example, both TDS and TCS on the same transaction happening, or the TDS, higher TDS happening in the case of the deductees who are not filing returns. So it was very difficult for a business or an organization to really keep track as to whether the deductee, the taxpayer, has filed a return or not. And that was raising unnecessary demands. It was an irritant, so that has been removed. The second component of trust first is the updated returns. So this has the response of the initiative that was taken about 4 years back, that has been really positive, really encouraging. So the updated returns till now were for only 2 years, which has been now extended for 4 years. Let me share that as a result of the communication being done by the department at different points in time, flagging issues, flagging the fact that some information is available which is not really corresponding with the tax returns that have been filed. As many as 90 lakh updated returns have been filed with revenue of additional revenue that has been additional revenue of about 8,500 crores, which is a substantial amount. So therefore, this concept has been further expanded, and the time limits have been increased from 2 years to 4 years, giving the taxpayer some space to actually comply in case the transactions come to the notice. Some simple but far-reaching amendments, such as easing the concept of computation of annual value of the house property. Unnecessary, some provisions were there, so those irritants have also been taken out. Then on the international tax side, if we see, some clarity has been given insofar as expanding the scope of safe harbor rules. So for electronics manufacturing facility, the safe harbor has been provided at the rate of 25% of the services or technology that is now that will be the professionals who may come to India for helping us in setting up those facilities. Similarly, on the transfer pricing front, a new concept of a block determination of ALP for 3 years has also been introduced. So these are initiatives, suggestions that have come from you, from the field, from the business, and that has been adopted. Because as the Honorable Finance Minister said, we have to keep our ears on ground, see what is happening, what is the ask of the industry, and accordingly align our tax policies to make it simple for the taxpayers. Because if you are comfortable, you would there would be better compliance, the business would grow, and therefore, as a result, the tax would grow. So it is basically a derivative of that. And I would close by saying that the department has changed, it is changing. The approach of the department is also changing. I have mentioned in the earlier occasions also, we are adopting a prudent approach. And the prudent is being proactive, rule-based, user-friendly, database, data-driven, non-intrusive, enabling environment, and technology-driven, transparent taxes administration. That is what we are looking forward to. That is what we are moving ahead to. With this, I would close. Thank you so much.
Thank you, sir. I would now request our chief guest, Mr. Tuhin Kant Pandey, Finance Secretary and Secretary, Department of Revenue, Ministry of Finance, to please address the audience. Please give a round of applause to Mr. Pandey.
Shri Manish Singhal ji, Secretary General ASSOCHAM, Shri Sandeep Chawla, Chairman National Council on Direct Taxes ASSOCHAM, Shri Rakesh Nangia, Chairman International Tax Council ASSOCHAM, my colleagues from CBIC and CBDT, distinguished audience, good morning to you all. A lot has been said already on the direct taxes and indirect taxes by the respective chairmen. Let me use this occasion to to respond to what was said, what FM said, that, the bureaucracy needed convincing. Well, I think overall guidance of Honorable Prime Minister was clear. This budget should be pro-growth, pro-people, pro-taxpayers. And Honorable Finance Minister actually guided us all through and spent hours and hours with us on different aspects. As you know, the budget making is actually balancing different imperatives. It's never an exercise in segments. The segments must join up. We must coordinate because economy being what it is, everything is interlinked. The cycles are interlinked. You try and intervene there, you may impact elsewhere. So it's very important to actually maintain consistency. And that is one part where for the first time in part A, we are talking of taxation. We have never done it. You know, earlier the taxation is always part B. We said in part A, as an integral part of the 6 reforms that FM announced, the very first is taxation reforms. And it's very important, as Ravi mentioned, you know, the taxation is one of the key things because after all, budget is a public finance document. It's an annual financial statement. And therefore, taxation has an impact on what the rest of the economy does. So we have balanced different paradigms here. One, we have maintained the fiscal consolidation path. That's important because we need to be non-inflationary in our approach. This is a time we aren't really having as deep a crisis as like COVID or things like that, where you have to follow certain different fiscal rules. We have been consolidating fiscally as per a defined path, and I think everyone, all citizens and anybody else who is watching Indian economy need to have a credibility on our numbers and credibility in our approach. And that approach is bring down that to 4.9% of FD this year, and we delivered 4.8. There was there was an announced path that we will reach 4.5% to GDP FD next year, and we are proposing 4.4. There was also an indication that we will have a debt consolidation path in terms of debt levels, and we have announced that in our FRBM statement. So first of all, it's very important to be very clear that we have to do within a certain fiscal regime, and we have to that extent aided the monetary authorities to see that if they have to do what they have to do, we are supportive. The fiscal policy and the monetary policy need to work in tandem, not at cross purposes, because a lot more benefit will come also with monetary easing if we are able to maintain the inflation under control. In any case, inflationary policies can really work only in the short run in terms of pushing growth. But if you have to have a sustained growth, we need to have good grip on inflation. Now, so therefore the balancing that we have to be compassionate to the taxpayers who have been compassionate to us all this while. We had a 20-25% growth in personal income tax over the last 3 years. So is that, there's a question being asked, are we shrinking the tax base? The question is, the income must rise. As I said, the income must rise, the economy must rise, and so will the taxes. We don't really gain very much loading taxes on the same kind of people over and over and over again. So tax base is also like, creating a wider span of income, also create a larger information utilities which will help people, as I said, voluntarily comply. And Ravi gave you an example of that. We can actually do a much more in voluntary compliance. And I think many tax consultants and chartered accountants and other tax advisors are sitting in this room, and we need your cooperation as well, is that more voluntary compliance, everyone contributes for Viksit Bharat. Viksit Bharat is our combined destiny. It's a vision that we all see for ourselves, and we must do it our best. Of course, we must also incentivize job creation. We must also create, and that is why a high level of taxation is counterproductive. We have not increased taxes anywhere here. This is another new bold step that we have taken, because normally you would like to give away something and then try to, take away something. And it's like, trying to neutralize. We haven't really imposed any taxes even on, the class. The surcharges remain the same, although some people might have expected that the surcharges will come down. But I think our direction is clear, that it's like expanding the base, expanding the economy, growing the economy, and I think the taxes will also flow. Now, consistency and alignment is very important. I think that was mentioned by you. And every decision that has been taken, it has been taken pro-growth, pro-people. And the tax proposals are fully consistent with what we are stating up there as a policy. Because it's the same document. You can't say something different in Part B relating to what you have stated in Part A. So therefore, I think our team did a wonderful job, and I must congratulate here both the chairs here, Ravi and Sanjay, and their team, and I think some of the names I am able to see that those joining, Ramesh will be joining, and then Raman, Pankaj and Lima on the other side. These people have really worked literally day and night to really work out something. Where my, challenge to them was that if you put up a proposal, then let somebody else be a critic, and let somebody else be, say, a taxpayer, and let him ask a question. And you ask the question, if I were you, if I were the taxpayer, how would I respond to this? What do I get out of it? So rationale must be there, and if you don't have rationale, then obviously, it's not convincing, because it will come. So therefore, I don't know. I have been watching the media and other things. I have not really so far, last 2-3 days, has really got the real puncture to, real arrow or something, that it was a big miss, it is something, an error. I haven't really yet actually got it. If you have really got it, please let me know. If you say that there is some inconsistency in what we have said, please let me know so that we will have a chance to correct that as well. But broadly, I think the approach that we followed was, we need to have a lot more preparation in what we really see, and that means that we should have an approach where when we do that, it is not that we are saying from this angle. Please look at from the angle of people, angle of taxpayer. So, and this will, I assure you, will remain our approach all through. We are very used to PPT. Let us have another PPT this year and next 3 years, next 4 years. And that will be pain point termination. Let's have a pain point termination. Wherever we find pain points, we start terminating them, and we identify, we work out. Any complex systems, any institutional development rests on an openness. The first is the openness. The second thing is competence, professional competence to really discover how to sort it. Third is technology. Fourth is, but before that, it is the will. And I can assure you, we will demonstrate adequate will in order to provide that sort of environment where our tax administration is not looked upon as something which is extortionist, somebody who is insensitive, somebody who is not there. We are there on that side. Today I am here, tomorrow I would be there. And in any case, personal income tax, everyone is a customer. So therefore, we are customer to ourselves as a personal individual taxpayers as well. So I think if we look at the trust first approach which finance minister so beautifully put it. We would actually go a long way in improving not only image of our tax administration, I would say we will collect far more with far less pain. And these transaction costs, reduction in transaction costs is what will propel the Indian economy. Because we have to discover, when we have so much of challenge, so much of headwinds, we have to discover our best as Indians. And we can only discover our best as Indians if we are able to say, here is the problem, what really goes from your pocket if you remove it? I mean, it's a question of really being sensitive to what we're doing. Transaction costs, regulations, the wastage of time, valuing time. We don't value time. Time is very important resource. We always count it in terms of 10 rupees loss or 10 rupees, but what about time? And I think that time, repetitiveness of the task, can we avoid it? If you have noticed, and I think people haven't talked about it, but very important in the case of customs and other things is our Bharat Trade Net. We have announced a Bharat Trade Net, which will be another much more than our UPI, where we would be able to connect different agencies, the banks and the agents and the brokers and the forwarding agents and so on, and the DGCIS and the customs, so that seamlessly they are able to communicate and do business. We have to set world standards. It's not a question of following standards. If we have a GST, and you may have several complaints about GST, but let me tell you, in terms of conception, in terms of this, nobody has it anywhere in the world. Nobody has it. Particularly any country which is federation with states. Like, for example, you may have Australia parallel to this, or you may have Canada, or you may have United States of America. Nobody has it. The kind of paperless exercise which this nation has put it together and all that. Let's respect the institution that we have created. All of us which we have created. The rate rationalization is, of course, an important thing. When we did it, it is like revenue, states and center coming together. A group of ministers has been formed. I'm sure they would also work on rationalization and trying to see, how we can do and improve it. But a lot has been achieved, a lot can be done. So therefore, I would say in areas of tax administration, both on the custom side and this and the GST, we will have to do a lot of proactive reforms, a lot of things continuously in the next 4 years to see that we are able to have, everything 2.0, 3.0 and things like that. And if we do that, your cooperation will be most vital. Because unless and until we join up together, we will not be able to really deliver what we are asking. So it's not you and us, you and we and they, it's we and we. And we approach sitting together professionally. We will, during this year, we will have several conferences, several discussions, and I was really talking about two of our gems here in the direct taxes member legislation, Ramesh ji and Raman Chopra. These are the people who are absolutely proactive. They are able to respond to suggestion, take suggestion, move forward. These are leaders, future leaders of tax administration. So give them a big hand. So I close it here because I think a lot more we will have from the questions. Thank you.
Thank you so much, sir. We will now be taking question and answers. I will first request our co-chairs on stage if they have any questions to go ahead. And then when you go to the audience, please raise your hand, identify yourself, your company. Please refrain from any comments on the budget. Go straight to a short question. But first, I leave the floor to our chairs and co-chairs on stage to ask their questions. They can come here otherwise.
Sir, I have only one question. For the updated returns, we see there has been a massive spurt. A lot of people have come forward and filed their returns. And now this period has been extended from 2 to 4 years because of the success we had it. Sir, the tax rate, if I'm not mistaken, is 60% when you file an updated return. Now 60%, 30% goes tax, 30% maybe for penalty interest. This is again a voluntary compliance. A taxpayer, he may have left it inadvertently. He had no intention to conceal this income basically from the tax office. And paying 60% taxes is actually a very big amount of taxes, sir. So it should not, it's not a punishment actually. He's suo motu coming up because there's a provision in the law. It is inadvertently left. He would have not claimed anything like that. He's a regular taxpayer basically. So I think that can be looked into this. I'm sure a lot of people may like to come more if it is something more easy to, that it's tax easy actually. So 60% is very steep, sir. I don't know, I'll leave it to you, sir.
60% of additional, not 60%.
60% of additional.
Yes. So what one has
So
to
the
see is,
income which has escaped, basically that is 60%.
yes. So basically what we have to see is there has to be a trade-off. One is 60% of the additional income.
Yeah.
And the rate has to be such that it should not create an arbitrage or incentive for a person to actually delay the payment of tax. Right. So therefore these two elements have to be balanced.
Okay.
You see? So from that perspective, you see that it's quite equitable. That if the person comes up and files an updated return after 3 years, it's not within 1 year or 2 years, after 3 years, the person pays something extra.
Thank you, sir.
Sir, two questions, if I may, with your kind permission. One is that on the transfer pricing, the block assessments, 3 years that you kindly spoke of. Now there, the legislation or the proposed legislation says that it has to be a similar transaction. And then if we read the memorandum, there are certain other illustrations given that the volume of transactions and certain other parameters also would need to be looked at. So is it only the similarity of the transaction? Because if you read memorandum, it says the volume, it talks about that whether the location of the enterprise would be the same, whether the contracting party is the same, etc. So are there going to be some more parameters which will be laid out, or is it only the similarity of the transaction that will be the key factor for the TPO to determine the option made by the taxpayer, whether for the next 2 years of the ALP, would that suffice, or is it that in the rules there would be some more factors which will be laid out for the TPO as a guidance?
Raman, since you are there, would you like to respond on this? So far as the philosophy is concerned, the philosophy is that while you are undertaking the exercise of determining the ALP, the TPO, since there would be 3 years which would be involved, and during this 3 years, the nature of the transaction is, if it is similar, nature of the transaction is similar, that could be basically different factors that could be associated and which would be basically, and it is option on part of the taxpayer. So the taxpayer would come forward and say, okay, I am exercising this option. This would be first examined by the TPO, and if it finds that based on the nature of transaction and maybe also the quantum and so on and so forth, it is of the similar nature, then the repetitive exercise may not be done. But if that is of course subject to discussion, you see, once the TPO is satisfied that actually it is a similar nature of transaction, then there is no need for a repetitive exercise of determining the transfer ALP. Anything extra?
Yes, sir. Just want to add that prescribed rules will come in the next few months on what constitutes a similar transaction and how the TPO will determine whether it is a similar transaction. Specific prescription will come on that. So
Thank you so much. Sir, one more question. Sir, in section 9, there has been a clarificatory amendment pertaining to significant economic presence. And very kind that this proposal says that a purchase by a non-resident for the purpose of export, that is to be excluded from the definition of significant economic presence, in line with the definition, in line with the main section 9.1 business connection. Now, sir, the distinction between goods and services is getting blurred. Even the Supreme Court in many decisions has said that, what earlier used to be only goods, now services are becoming more predominant, and we never had even conceptualized that there would be a distributor of services. Now we have that, and even Supreme Court very recently in Bharti Airtel's case decided on that yes, there can be a distributor of services as well. So sir, my question is that this purchase of goods, this was brought into the statute in 1961 pursuant to the earlier circular 20 which was issued in the earlier law, because of a particular situation, because India wanted more exports to happen because of foreign exchange. So they said, okay, if a non-resident is to come in and purchase goods from India for the purpose of export, it will not constitute a business connection. Now with the services which are becoming quite a very important and significant part of our economy, can the definition of goods also be amended to include services? So a non-resident who's purchasing services from India, be it any kind of services, and it's only for his utilization outside of India, could also get out of the purview of significant economic presence and business connection.
I think this has far-reaching implications. It is not goods per se is identifiable sort of a thing. It is one relaxation that has been given. It's some exception. But extending it to services is opening a whole very big area, which is actually not the intention as on date as when we have brought out this amendment. Because that is opening up a whole new area which needs a very, very thorough examination. And we have to see it as a country. It's not a question of only one provision, it's basically we have to see it as a country.
Thank you, sir. Thank you very much.
Sir, I'll have a very quick question from the international taxation perspective, where recently the executive order which has been signed by the Trump government, where they have decided not to participate in the OECD Pillar 2 approach. So with this, what we as tax professionals, we have the assumption that last year EL2 was dropped because of this reason, that Pillar 2 15% standard benchmark rate will be introduced. So now what is the thought process behind it, as we see that US doesn't seem like cooperating with OECD and doesn't seem like coming on the table to discuss for a standard benchmark rate of 15%. So that brings a challenge for India while it comes to the digital economy taxation, sir.
I think US exit has added a whole lot of uncertainty to the whole thing, whether Pillar 2 is going to work or not. I think some jurisdictions have already carried out legislative changes. We haven't. We had also some reservations, which we had noted earlier in the statement when it was made. So we have to now evaluate, because it doesn't work. I mean, if US is not into it, that doesn't work.
Right, we will take one question from the audience. Please raise your hand. So I see one raised hand here on this table. So please identify yourself, the company, and please keep your question short.
I am from Nanded, Bias Nagla. Section 206 AB abolished for specified persons in TDS, but Section 206 AA for inoperative PAN is to be extended for 1 year. Circular number 6, 224. Most of notices are issued for this inoperative PANs.
So what is the question, sir?
206 AA इन ऑपरेटिव पैंस के लिए जो नोटिसेस है उसके लिए एक्सटेंशन था 2024 के अंदर एक सर्कुलर, वो सर्कुलर की डेट 1 साल के लिए और बढ़ाना चाहिए, क्योंकि उसमें से नोटिसेस जो आई है पूरे गवर्नमेंट डिपार्टमेंट को ही है इन ऑपरेटिव पैंस के लिए। नांदेड़ में रेलवे डिवीजन को 202 करोड़ का नोटिस है, तो बाद में वो लोगों ने ऑपरेटिव करके ले लिया है पैन, पर डेट वो 31 मई ही है। अगर आप 1 साल और बढ़ा के देंगे डेट, सर्कुलर लाया मैं साथ में मेरे पास है, आपको सब दूंगा।
आप एक काम करें, यू कैन मेल इट टू अस। आई थिंक वी आर नॉट वेरी क्लियर, द टाइम इज अगेंस्ट अस।
नहीं लाया मैं, सर्कुलर लाया सब।
नहीं सर, थैंक यू सो मच, वी विल आंसर योर क्वेरी। इस समय
एक साल और बढ़ा के दिया, एक्सटेंशन दिया वो सर्कुलर को, तो नोटिसेस बहुत कम हो जाएंगे टीडीएस की, शॉर्ट रिकवरी की।
या आपने ये इशू फ्लैग किया है, इसको हम लोग एग्जामिन करेंगे, इसको देखते हैं।
ठीक है सर।
All right, one last question, so keep it short, please.
Yes. So my name is Sanjay Beswal. I wanted to check about the export things. So in the budget also, Finance Minister also mentioned that export is an important part of the economy. Exports do constitute something like 20% of the GDP. Now all the incentives, etc. of the exports are gone. What probably remains is the road tax, which is the refund of duties and taxes. Now, even in the road tab, what is being observed is that a minuscule budget is being, given. Road tab rates are in any case conservative. फिर भी जो दिया जाता है, that is a small some 16,000 odd crores that was given, which was not enough. Another 2,000 crores का provision था. My question is, why can't the road tab be the budget neutral? Road tab in any case we are saying is the refund of taxes and duties. And exporters are not getting any incentives as such. Yes, there are things like Bharat Trade Net, etc., which will help the exporters, no doubt. But जहाँ तक duties and taxes की बात है, वो तो कम से कम पूरा उनको वापस मिलना चाहिए. Road tax should be budget neutral.
नहीं, road tap तो continued है, both road tap and ROSTL on the textile side, both continue. 10% increase भी budget में हुआ है.
So that's what I was saying कि there is an amount of only some 16,000 odd crores, 2,000 odd crores extend किया. SEZs, advanced license, EOU के लिए जो स्कीम था रोड टैप का, वो भी स्टॉप कर दिया गया. एक्सटेंशन ऑन जो स्पेशल इंटरेस्ट रेट्स है, वो भी जो है अभी नहीं बढ़ा है. These are the important aspects of the exports, and it is not incentives. These are the refunds per se. Why can't we make it budget neutral? Maybe another 5-10,000 crore rupees का expenses होगा, and exports constitute 20% of.
नहीं, इसके बारे में हम लोग डिपार्टमेंट ऑफ कॉमर्स से बात करेंगे.
जी सर, थैंक यू.
Thank you. Please give a round of applause to our dignitaries for patiently answering all the questions. I would now request Mr. Atul Puri, Co-Chairman, International Tax Council, ASSOCHAM, to please give the concluding remarks. Please put your hands together for Mr. Puri.
Thank you very much, Anisha. Thanks you very much, sir, for showcasing the trust and the trust between the taxpayers and the tax officer. The very statement from our Honorable Finance Minister with respect to building the trust first and then scrutinize itself showcases the strength between the two agencies. Sir, I believe this budget, which is by the people and for the people, and has been heard well, giving them disposable income in the hands of the individuals. I would just mention, give reference to 3 things. The great architects behind, or the brains behind this budget, where specifically after years there's been a significant amount of rebate given, or the additional disposable income given to the middle income class. From 7 to 12 was something which was unexpected. Of course, we're going to have multiple rounds of discussion during the panel discussions, but this was something unexpected and has brought a lot of cheer among the entire taxpayer community. Second is with respect to the rationalization of, post-rationalization of the capital gain. Last year, we did a strong representation before the architects on the capital gain restructuring or rationalization, which was done. And TDS, TCS, in this budget is a very welcome move. This was actually required to make certain changes because unnecessary it was blocking the working capital for the taxpayers and also adding the additional burden on the revenue side as well. Lastly, the trust, the growth is most imperative, and this budget is very well in sync with this thought process. Sir, as you mentioned, Ravi sir, that this is a budget for the middle class which has brought smiles to their faces. So I'll rhyme it in a way that middle class smiles, the gold shines, capital market twines, and the nation on the path of growth illumines. Sir, on behalf of SOCHM Council leadership and entire team, I would like to thank Honorable Finance Secretary Mr. Pandey, Mr. Ravi Agarwal, CBDT Chairman, and Mr. Sanjay Agarwal, CBIC Chairman, for their eminence, for their importance, and their presence on this important event of SOCHM. We thank you very much, and we look forward to a very interactive and imperative sessions today on both the changes with the eminent speakers on direct and indirect taxes. Thank you, sir.
Thank you. I would request all our dignitaries on stage to please get together for a group photograph. I request everybody in the audience to please remain seated. There is no break. We will continue with our next session. I request all of you to please keep the aisles clear. Please take your seats. And there is no break. We will continue with our subsequent sessions. I have a request to our media friends. In case you have any questions to our esteemed dignitaries, kindly ask them outside the hall. We will be continuing with our sessions without any break. Thank you all for your cooperation. Please give a round of applause to our dignitaries on stage. We would like to thank our chief guest, Mr. Tuhin Kumar Kanta Pandey, our Finance Secretary and Secretary Department of Revenue, Mr. Ravi Agarwal, Chairman CBDT, and Mr. Sanjay Kumar Agarwal, Chairman CBIC. Thank you so much for your time, sir, and thank you for patiently answering all the questions. We will now go ahead with a panel discussion on the analysis of direct tax related proposals. The highlight of Finance Minister's budget this year has been the announcement of a tax rebate by which those earning up to 12 lakh rupees per annum will not have to pay any income tax. Individuals earning a higher income of up to 50 lakhs will also end up paying a lower tax rate. Plus, there is a new income tax act which is expected very soon, perhaps in a week or so, which will be unveiled, and we'll try to get some details on what this could look like. So please put your hands together and welcome on stage our session chairman, Mr. Ramesh Narayan Parbat, member legislation CBDT, member of finance. Please welcome him with a round of applause. Please welcome our session moderator, Mr. Rakesh Nangia, Chairman, International Tax Council, ASSOCHAM. Please welcome our special guest, Mr. Raman Chopra, Joint Secretary, TPL1, CBDT, Ministry of Finance. Please welcome Mr. Vineet Agarwal, Co-Chair, National Council on Direct Taxes, ASSOCHAM. Please give a round of applause and welcome Mr. Hitesh Sani, Partner, Price Waterhouse & Co. LLP. Please welcome Mr. Nitin Jain, Partner, Global Tax Advisory, SW India. I would request Mr. Rakesh Nangia to please welcome Mr. Ramesh Narayan Parbat, our session chairman with... Okay, I think Mr. Nangia is just about to come. I would request Mr. Vineet Agarwal to please welcome Mr. Raman Chopra with a bouquet of flowers, and once Mr. Nangia is here. All right, Mr. Nangia is just seeing off the dignitaries. Mr. Ramesh Narayan Parbat, Member Legislation, CBDT, Ministry of Finance, with a plant. Thank you so much, sir, for taking the time to come here. And the entire audience is waiting with bated breath for your clarity on the direct tax proposals. I would request Mr. Vineet Agarwal to also welcome our special guest, Mr. Raman Chopra, Please welcome Mr. Raman Chopra with a plant. We want to thank Mr. Chopra for taking the time to come here. Right, thank you so much. I will hand it over to Mr. Nangya, our session moderator, to steer this discussion ahead.
Good afternoon, everyone. Sorry being late. I was outside. So we just have one small observation, basically, when this new code came, and there's no specific question on it. I understand the limitations. Earlier it was called DTC, Direct Tax Code. Then it became a Comprehensive Review of Income Tax 2024. Then it became a new income tax bill at 2025. In spirit, I think everything remains same. It is just the scope has been extended beyond what is earlier visualized. That was in the DTC time. That was in 2008 or 9, something like this. So,
As you know, that the 2009 experience and the 19 experience, basically it was focused on direct tax code because other taxes, direct taxes were also being subsumed into the income tax portion, and that is why the direct tax term came at that time. Presently, it is only in the FM speech for July. If you go through this speech on para 131 or something, I don't remember exactly, it is clearly mentioned that a comprehensive review of the Income Tax Act to make the language simple and easier to understand. So that is the mandate, that is what the committee worked on, that is what the board worked on, and that is what is likely to come next week. I cannot share anything beyond that at this point of time because the parliament is going on.
I did a little bit of research, but I want to share something very interesting, facts and figures. I may be repeating it. In 1980-60, it was the first time when India was subject to income tax. That was exactly 185 years back. The income tax was levied in India, where rupees 200 was a basic exemption, and the tax rate was 2%. That was 185 years back. In 1886, the first time a separate income tax act was passed for the first time. Very interesting facts. So you will be surprised, worldwide, 1188 in England, the first time the tax was levied, where the tax rate was 10%. I'm telling you, historically, in UK, the tax is coming from centuries and centuries and centuries. We could never imagine 1188 the tax was levied for the first time. Friends, we can't talk much on the new income tax code and the comprehensive bill, basically, but we'll share some nuances of it, and we'd like to have your thoughts, and we'll share our observations on it. And so, just to let you know, there are 298 sections in income tax law. There are 25 chapters. There are rules, there are sections, there are subsections, there are clauses, there are schedules.
More than 800. I'll correct him on that. It is 298, but it is actually on this point of time, it is beyond 800. Because there are so many sections, 115, if you see 115 only, I think section 115 with the not the subsections, but the ABCs after that, takes it up to at least 50 sections under 115 only. So
yes.
it is
Yes, so you rightly said, I mentioned section, subsection, clauses, schedules.
Not only subsections.
115 J, JB.
Okay.
Sir, I think even 50 is lesser, because yesterday only I was saying 115 VP something, VPT. So actually it is running into 100, maybe more than that.
And so what happened when you see the law becoming so complex? There were so many budgets from 1961, there have been 65 budgets, there have been amendments in this 65 years, there are changes that have brought, and the changes because of a settled position, because of litigation, there have been redundant clauses, there are sunset clauses, and hence there was a need of the to completely review the income tax, and it's one of the most daunting exercise taken by the tax office, where a complete revamp, a comprehensive bill is being placed, is likely to be placed, or will be placed next week, in the parliament. And it has emerged, so you can correct me, that more than 90 sections have lost their relevance. This is what I could manage to get the information. And obviously the whole panel has been given the task to give suggestion to simplify the decade-old income tax law. And as I said in the beginning, it is a comprehensive review. Simply one small thing, will it be a new law, or will it be a complete, I know the number of words from 6 lakhs to 3 lakhs words have been taken out, or it will be just amendment of the Indian Income Tax Act. It will be, or Indian Income Tax goes to the oblivion. Sir?
I can only say what FM has already announced. It will be a law in simple, lucid language. So even a common graduate will be able to understand it. Our effort is this only.
Thank you so much, sir. Sorry.
More details you will come to know in 1 week.
I can understand, sir.
No, as part of, SOCHM has also been part, we were also called by Honorable Revenue Secretary at the time.
Yes.
I can just tell that the tremendous efforts which have gone into this new exercise, because in fact, I represent the other side also, a lot of my batchmates have been part of this exercise, and I know what kind of efforts have been made, what kind of committees, subcommittees, senior officers of the rank of principal chief commissioner, chief commissioners, joint commissioners, everybody, the kind of work which has gone into this last 6-7 months. It's tremendous work, and we should actually clap for the entire department for that.
And I must compliment one more thing. It's the first time I think, sir, we were invited to give a representation as a chamber. I think it has never happened in the past. Midway exercise, we were invited to give top 20 suggestions so that they can cater to that, understand the pain of the SSCs, understand the other side of the table. So this was something of very receptive.
I will just add to that. We also gathered advices from the general public also. And we received how much? 6,000. More than 20,000 suggestions were given by common public. So we have also gone through that and tried our best to understand them and incorporate them.
So one thing which baffles me, I'm using a word baffles me. New income tax bill, is really very appreciable. We had challenges, it has become clumsy, it has become big. Tell me, sir, what happens? Every section is rewritten. It has taken 65 years to understand Income Tax Act, the section, the meaning, the interpretations, the definition. Is it if we rewind ourselves everything? We go back actually. There may be some case decided by Supreme Court, government may have agreed, not agreed, brought back into the law. I'm saying like that. How do we, it's a reinventing, going back everything actually. I'm not saying, we are not being critical, but I'm just trying to say a little bit changes are acceptable. No, there's a rewritten. We have to study the law from basics, from ABCDs actually.
मेरी सिर्फ एक सजेशन है, आप 10 दिन वेट कर लें, then we can have this discussion again. So that is my suggestion to you. We will certainly meet and certainly have discussions, because अभी आप presume करेंगे क्या हो रहा है, क्या नहीं होने वाला, उस पर हम comments दे नहीं सकते हैं. तो इस वजह से my suggestion is that we'll meet again.
Sir, one question here. So, though the bill is coming next week, what is the intent of the government to have it implementing? So, are we going to see it from the next year, or we are going to look at another sort of 2 years when it's going to really become an act here?
Actually, as it is, the process is followed. The bill will be sent to the standing committee or the select committee. It is up to the parliament to take whatever time it takes to study the bill, take inputs from stakeholders, then give a report on that. We absolutely cannot comment on the timelines at this point of time. As soon as it comes, we'll be in a position to implement it. That is what I can say.
Okay, understand.
So one of the things which was the very high on expectation, and which was the need of the hour, need of the economy, the way we believe on this side of the table. And actually it is closely worldwide everywhere there. The low taxation, 15% tax on manufacturing, basically. It's just a buffer, it's just icing on the cake, sir. It's not a main impetus. But if you see globally, manufacturing is given impetus through tax levies, and it's generally taxed at 15%. India was laudable, but sir, just to remind you, it was there for 4 years, I think, or 5 years this tax was there. 2 years went in a COVID. When you put up a unit, it takes to plan it, out of the drawing board. It takes another couple of years to do that. By the time we realize it, actually, it was over. It was over. And it is not something, you have a China one policy. You know we are not growing in manufacturing. We are, MSME sector is only growing, but manufacturing to GDP is actually struggling to maintain 13 to 15%, which is a very big challenge. So what was the reason, I'm not saying ki this was not considered, it was not considered adequate or it was not fair to give this tax to manufacturing, exemption to manufacturing. What is the rationale, if it is possible to
May I add a query here, because I am the industry representative here. So basically, if you see in this budget, now let's start with good, bad, ugly, everything, right? So industry expectation was always there that yes, manufacturing should be given a fillip, and it was there. And like if you see this year, the sunset clause has been extended by 5 years. That's the kind of certainty industry wants. Even like these startups, 5 years, again, all those things, most of the things which have been shifted to IFSC, again for the stability part, right? But when it comes to manufacturing, and especially in the case where we are expecting GDP growth of 8% to get that 2047 Viksit Bharat, right? And we are struggling at 6.4, 6.5. Not only domestic regions, there is a global headwind for that, and we have to live with that. But certainly, certain impetus has to be given domestically. And if you see what has fallen in this, there is a slowdown in manufacturing. You want jobs to be created. Now, all jobs cannot be created under gig worker things or in services sector. Services certainly give. I may be crude on this, but services means what? You scratch my back, I scratch your back. Are we creating any assets out of it? Nothing. So assets are created out of manufacturing, and manufacturing growth is going down in this country. What direction this budget or even this honorable speech of Honorable FM has given, I doubt that any direction is there for manufacturing per se. When the little effort which was made in 2019 just before COVID was for tax impetus for this new manufacturing companies. As you rightly said, by the time people could understand it or those new companies could be formed, COVID came and 2 years went down the drain. And by the time things started moving on drawing board, I'm not saying on the ground, it was over. 2023 was the last year, then it was extended for 1 year, and despite request, it is a matter of study now how many new manufacturing companies actually came and how much was manufactured in that. So probably there's a need for the government. Ye dil mange more for everything, okay? And we despite this good budget, we all of us had something, no, ye reh gaya, ye chota sa ho jata, of course. But a larger context, if you ask for, something which is missing is that growth for manufacturing is not there, and probably government will think after that. 15% or that 19% tax rate and 25% tax rate, it makes a hell lot of difference. It gives psychological boost, yes, that's of course, and it's not that you are creating some exemption, etc. Of course, as we rightly said, that you give that 1 lakh crore to the middle class and the economic cycle starts. The same happens with manufacturing also. Manufacturing brings growth not only to the raw material providers, labor, job creation, but service providers also simultaneously. So that's.
Sir, just want to, sorry.
Yes, please.
So while we are on a manufacturing, I just wanted to add a perspective. See, when I look at this budget, there is a strategic change in the way the government has gone about, whether it's consumption, whether it's providing certainty on certain issues, because it's about the certainty and the stability which every investor looks at it. I think manufacturing is a piece, we are trying to fix it up. As Mr. Nagia rightly mentioned, that it was for a short period before anybody realized it went away. There are various enablers for any manufacturing facility. It takes a long time. It's an ecosystem to be set up. It was pleasure to see that you extended a certainty about technology or a service only to manufacturing and semi, but that's again a piece which we are looking at as well. There are various other manufacturing aspects where we want to grow. Why to limit it for that? Because any new manufacturing would require technology. In this budget, we talked about nuclear power. Tomorrow, we need a support for that. Why only to restrict to that? It's a certainty which requires technology transfer and everything. And manufacturing don't need a 2 years extension. It needs 5 to 10 years because any facility to set up takes about 3 to 4 years.
So I want to add here before you, is there a number of countries in the world, China also has it. when you have to boost manufacturing, and you have given such a relief, government is so practical understanding, I'm sure all the data are with the government, why, it has a cascading effect, it's a catalyst actually for the economy. And it's there in a number of countries in the world. To you, sir, to you.
First of all, the budget as it comes should satisfy expectations, but the expectations should be rational expectations. Manufacturing का कट ऑफ डेट 31/3/24 था, 25 नहीं था. This discussion could have taken place sometimes after March 24 or at most after July 24. Once the government has taken a call earlier itself, then having an expectation at this point of time that something will be extended is not a very fair expectation. On the generality of the whole process, yes, manufacturing needs to be pushed and promoted by the government, but whether only a tax rate will promote manufacturing, that is in itself a question. We've had manufacturing related incentives for 0% tax for 10 years, 15 years, in a block of 15 years, for 5 years. Chapter 6A was already in place for n number of years. If zero tax or low tax is not the only enabler for manufacturing, that is my call in it. The government took a call in 24, before 24 itself, that the section needs to go. It is already gone. So having an expectation that will be extended for 5 years is not a very fair expectation at this point of time. So that is my remark on that.
Okay. Yes, sir.
And I will just add, there are some provisions relating to manufacturing, particularly of electronic industry, for global value chains, and safe harbor rules implementation has been announced for supply of components. The vendors who can store in India and supply to local manufacturers. So all these will lead to at least boost in that field. And as Raman has already pointed out, Section 80 IAB, whatever was that. So, but many of the earlier sections are still continuing. Means, for startups, again, we have increased for 5 years. So up to 5 years more, they can be incorporated and they can begin their business and all, and avail the benefits.
Sir, one more thing that you just mentioned about manufacturing. I want to touch the startup actually. A lot of things have been said in this budget on startup, and I said in the morning session, I don't know whether Aptheni, this first 10,000 crores which the government gave for startup, today valuation is 90,000 crores. That has been a value appreciation taking place by the government funding of that. It's very clear government gives a lot of impetus and meaningful support, or to the startup is concerned. I have two questions, but before I say that, I have one important. We have Startup India. We had a 10,000 corpus fund. We have Atal Innovation Mission. We have a national D-tax startup policy. We have angel tax replenished. We had a reverse flipping has come back. 159,000 DPITT recognized startup application has been approved by the government. There is a 8 billion of money was raised in 2016, sir. And from 16 to 24, 155 billion money has been raised by the startup. It's so important, basically, to say that. There are 110 unicorns in India, basically. So I'm just trying to say the importance of startup there. Now, when this scheme was announced till 2030 for extension exemption, actually, it was being raised yearly basis. From then, government gave us certainty. One thing which we believe, there was people of startup came here, you could have extended 3 years to a little more period, but the 3 years remain same. You've extended a scheme, you can take 3 years in 10 years block. So that was not extended, but only the date, sunset date has been extended till 30. So I think that could have been considered by the government because the contribution is so high on the startup. Employment, sir, even employment ka nahi bataya, capital ka nahi bataya, there are unlimited advantage which the startup is giving to the country, sir.
And to add to it,
technology. I'll give you, sir, one small thing, sir. I was talking to a startup, I can name it, like the company which manufactures glasses. So they make 1 lakh glasses a day. They be funded so much, they have 1 lakh. You enter the factory, you are in Japan. It is in Manisa, sir. So the contribution is high. So ये थोड़ा सा exemption 3 साल से बढ़ जाता in the block would have been a welcome step. So maybe rationally.
Sir, on a startup, just one realistic point. Most of the startups do not make profit in the initial period. So effectively, the 3 years is not that any benefit goes to them. So whether we could have looked at 5 years in a span of 12 years, and that was staggering, not the cumulative, because once they start claiming a reduction, they have to continuously claim reduction for 3 years.
Yeah. Yes.
So there could be ways to incentivize. It's a benefit which they are not able to avail it.
If you are aware of Chapter 6A, there is only one section which is alive at this point of time, which is a profit link deduction. Only one. And that is the startup section, 80 IAC. No other section. Government from 2015 onwards has moved away from all deduction exemption regimes. We are focusing on lower rates of tax, lower slabs. That is how the whole philosophy of the government is functioning. So 80 ISC per se is also an aberration on the lower rates of tax which carry on. Still, it is retained keeping into account the immense potential and necessity of the startup framework. That is the only reason that a special regime is actually given for startups. Both on the ESOP side, you can see there is a regime, TDS side, the demand side, the perquisite side, everywhere that integrated regime has been granted to IMB startups. And angel tax was done away with.
Yes.
So, but profit link deductions, we've moved away, we are not intending to give, we are still carrying on for the startups. I think that is fair to an extent. And 3 years out of 10 years, if it doesn't make profit, doesn't need to start taking that incentive. When it makes profit, it takes that incentive for 3 years.
Atul, you had something not on what has come, what is something which has not come.
Before that, Nagari. Sir, we understand the importance of startup, the impetus what the government is giving to the startups. But we all know that probably 1 or 2 out of 10 startups, they generally flourish and the rest of them fail, right? But if you look at, there has been a demand from the startup industry because that's going to encourage a lot of merger and acquisitions in that. So there is no benefit of the losses what they incur when they merge with each other. Because on the merger, because they are not getting qualified as a specified industry, so whatever the loss they incur, they just go away.
I think you need to check that up again. There is a provision in 79 which excludes the startups, which are IMB approved.
Okay.
I think you should check up. If there is something, you can mail to us.
Sure, sir. Sure, sir.
So we were discussing what has not come also. So I said, yes, that will be.
Raman sir, you have always been a great support when we discuss something what is required in the Act. So couple of things. One, Section 139(8) you updated, where there has been an amendment in this budget as well. What also we would like to understand the logic behind that. When there is an incremental income or a revenue towards the department, then you can make the changes. But when there is an error which has happened on the account of the assessee, where there is a reduction in the income or there is a reduction in the tax liability. Earlier this used to be there that we had the option to revise the return till the date of the assessment or the end of the 1 year from the end of the assessment year, whichever is earlier. But now that has been done away. So in case, especially in case of an international tax return filing, where the due date is 30th November and the last date to revise the return is 31st December. After this, the window gets closed. Now, if supposing there is an error which is from the assessee side, which can reduce his income, and it's a genuine error, I don't have any option available. But when there is error is on the other side, where it increases the tax liability for the revenue, then that 139(8) as an option is available. So, why this discrimination is there, and is there a possibility it can be eliminated?
See, this updated return, that is for the benefit of the assessees, Earlier, if any mistake was there, revenue came to know, then what option was available except for reopening the case? And that would have resulted into so many proceedings. Now an option is there. First of all, see, all this is part of trust. First, we started sharing the AIS. So whatever information comes to us, we share to the assessee that you please check, you file your return accordingly, don't miss anything. So we don't want to intrude into your activities. You take your call. After that, many information comes later on also. That is also uploaded, that is also informed to them. So if any SSE comes to know that, yes, I have missed out on this, at least he has got now an opportunity. Before department takes the action, they can update their return. So what if Honorable FM had announced, trust first, scrutiny later. So we are trusting, now we are trusting up to 4 years. So up to 4 years, avenue had been granted. So far as this date of revised return, etc. is concerned, see, we have been reducing all the compliance dates, whether for the SSE or for the department. Earlier, we used to have the scrutiny assessment time barring date also up 2 years from the end of the assessment year. Now that is also reduced. Our officers also get only 1 year for doing the assessment and all. So that is fair. We have to be careful, and that only I can say. But that limitation of time is for now everybody, whether it is for the revenue or for the SSE.
So one thing, so one of the important element of trust is bringing certainty and speedy disposal of the cases. We don't see anything on how the appellate authority, especially faceless CIT appeals, how the speedy disposal can be made, because there are a lot of cases pending. Even the bar which has been there, there are no cases which are moving on. So from a tax administrative side, these things will also help the taxpayer to know the certainty.
See, so far as appeals are concerned, yes, earlier problems were there, but we have taken many proactive steps. The post of Joint Commissioner Appeals were created for small appeals. DRC was also operationalized. They have also started working. We went to the extent of even allotting appeals to our principal commissioners. They are administrative commissioners, but they have also been, many of them have also been given the job of this disposing of the appeals. This all has resulted. Now, data I don't have with me, but now the number of disposals have gone up substantially. So I hope in near future, this grievance will not be there. We are aware of that problem, and we are taking steps to do away with that.
Vineet, you always have a problem on TDS and rationalization taxes.
First of all, this appeal only.
Okay.
I mean, my experience from the industry side is simple but different, that most of the appeals now, see, the number of scrutinies have gone down substantially. And after this amendment of 148, new provisions of reopening, probably that will also go down, because now you are examining only 5 years, which is very, very less. Okay. The problem is somewhere else now. The problem is CPC. I mean, most of the appeals which are being created now is because there is a black hole called CPC. You file a return, and CPC, we do not know under which law, under what powers they are working. I mean, they do everything which normally an assessing officer would also not have done under 143(1). They deny everything, they delete, and the problem is that when you get the demand of 200 crores, you do not know whom to talk to. You file a rectification. And the rectification, they simply give you two options. File a revised thing, or you file a simple reprocess the return, right? And you keep on going in the same circle, and that rectification never happens, and finally you land up in an appeal. So I do not have the data, but I can vouch that 50% of the appeals are coming out of 143(1) orders, which a simple assessing officer could have done very easily. He would have simply seen the records and would have allowed it. So something which would have been resulted in 154 or rectification is now resulting in appeal, and these are pending for ages now.
Vineet, that also is being looked into, and now the rectification rights are being transferred to JAOs, jurisdictional assessing officers, very proactively. Thousands of them have already been transferred. So what you think that assessing officer can see it and correct it immediately, that will happen now.
Yes, thank you so much, sir. That would have been my suggestion, that immediately after processing, subject to certain benchmarks, if the rectification rights may be transferred directly to JAO, at least we can go and explain to them. And thank you for that, sir, if the proactive that action has been taken.
In fact, आपकी information थोड़ी सी dated. I'll just update you on that. Now, if you go to file a rectification petition, there is an option to directly file it with the JAO. So you now presently the utility tells you, allows you to file a rectification application to JAO. So the basic problem of 6 months getting lost with the CPC and still being in that uncertainty and the demand continuously hanging on your head, and again the order coming back from the CPC in the same manner as it was originally. That was the position. It has been corrected. You just go and check out the website. It tells you can file that.
Sir, obliged, sir, if that has happened, because yes, that will really be reassuring, and that actually reassures that yes, government is listening to us.
Yes.
Yeah.
I would like to appraise you that generally the JO doesn't have the rights to rectify.
Exactly what they're talking now, that has been done now. Yes, so that exactly what.
अब check करें अब
अब
problem
हो गया है, तो it's really it's a good sign that yes, that's happened. Now coming to TDS.
I will tell you, Vineet, this government is now always listening to you.
Thank you so much, sir.
No, we can make out, sir.
Thank you so much, sir, for that.
Thank you so much for reassuring. Yeah. So, Adar, now you are talking about TDS.
Yes, yes,
So,
TDS.
before that, yes.
So, not tedious, I just wanted to have this step on this manufacturing service certainty which you have provided. Do we want to extend it to other new age industries, like there are data centers which are looking to set up in India and they do not consider because of the lack of certainty of the taxes? There has been for an international taxpayer a secondment of people has been a big issue for last few years. Their judgments are both positive and negative, which unnecessarily creates a litigation and uncertainty. Can we look for some clarifications on that? What is
Decisions like?
such secondment of people? Like all this technology, new age requires people to be in India. There has been a positive as well as the negative judgment whether the secondment can create a P or a FTS. So unnecessary leading to a litigation. Data center is another thing. Like they need a certainty how the data center taxation would happen in the case of foreign company. So it's a very good direction in which the government has moved to provide certainty, but not only to the manufacturing or electronic manufacturing, there are various other industries.
On that, in fact, the present proposal is only for electronics manufacturing. Let's be very clear about that. And that too, which under a scheme approved by the MIT, and only to those centers, the services rendered by the non-resident will be chargeable to tax on a certain profit of 25%, and then you apply the 35% rate to the non-resident, and it comes to less than 10%. So you are paying less than the treaty rate on any services rendered to an electronics manufacturer in India. That is the law at this point of time. On other sectors, there are two processes by which certainty can be achieved. One is the presumptive tax under section 44 BBC, BBD. Last year we brought the ship cruising thing, this year we brought the electronics manufacturing. The second part of certainty is safe harbor. Safe harbor originally used to come only on transfer pricing related to ALP with associated enterprises. The first safe harbor on business connection, subclause 1I of the section 92D, has come for diamond rod, say sale of rod diamonds. So there we have a clear window for safe harbor giving connection on profit attribution or profit allocatable to the Indian jurisdiction by way of business connection. I would request you to you come up with your proposals to the Safe Harbor Committee so that we can consider them. You are the ones who have to tell us that how much is the profit which is attributable to a godown simply set up in India or a data center set up in India. How can I determine the profit attributable to a data center? What is the profit from that business connection for which a certain service is being rendered from here? Once you give a proposal, we'll consider the proposal, discuss it, analyze it. If it is fair from the revenues perspective, the government is focused on tax certainty. The entire budget, if you read the budget, it is focused on tax certainty. We need to give you tax certainty, but we need your assistance for that. We can't independently give you because that will be of no use.
Just add to Raman, it's an ongoing process. It has already started with diamond industry, now it is coming for global value chains. So yes, whatever proposal comes to us, it is discussed at our level, our seniors level, and then we will come up with something. We want to do this.
Thank you so much for this assurance, sir. Thank you, sir. Sir, something coming on international tax and especially on Pillar 1, Pillar 2, I have an extreme level of thought on this. both on minimum tax and the digital taxation. BEPS Action 1, which was digital economy, came in 2012. Today we are sitting this is nothing to do with India, this is a global issue actually, that's a part. But I just want to understand the perspective of the department. 12 years have gone by, earlier objective in 2000, I still remember very clearly, it was saying we want to ring fence the digital economy. Now you have to ring fence the other economy because digital economy has become so big, you cannot even think about ring fencing it. There have been 12 years of debate on taxing the digital economy, and they're finding a way out to come out of it. And I just want to, I wonder basically, how do we, if this is a global issue, India has, by the time a new business model or government brings the taxes, a new business model comes up which runs away being non-taxable. Fluid of free mobility of manpower, free mobility of capital, free mobility of services, and everything is, this thing is making more and more difficult for the digital economy getting taxed. Now US has already given statements which is not palatable in the sense that they are giving from their point of view, taxation point of view, but we are thinking from India point of view, this sector is not getting taxed, whatever may be the reason may be that. So what is way forward? By the time we plan or we bring a section out, it becomes outdated because of the technology. It's a technological issue actually. How do what is being done, how to do it, how to tax it, how to ring fence it?
Fundamentally, it is not difficult to tax. But the main problem which you've missed out in your question is, domestic tax does not override treaty. And to amend a treaty, it is extremely difficult. We do not have at this point of time multilateral instruments which override a lot of treaties. We do not have too many multilateral instruments. So unless we have a specific MLI which overrides treaties in such a manner that base erosion is prevented and taxability goes to market jurisdictions and market jurisdictions are authorized to tax incomes on the basis of the market from where such income is arising, it will always be subject to the permanent establishment and some business taxation which is present in all treaties. And amending a treaty with US is impossible. And it is a 10-year process. You can't say that we are technologically poor and lagging behind in our domestic legislation. No, we are not. We can come up with legislations for the cruise shipping. In fact, they had come up in about period of 2 months, we actually put that legislation on paper. So we can do it quickly, and that was done because it was coming from a non-treaty country and they wanted certainty for a non-treaty position. If they are coming from a treaty country, amending the treaty, impossible. So I don't see a ready solution to your problem. I do not see.
So even equalization revenue has been withdrawn so many places. Even what the government was collecting the revenue in anticipation, the digital economy taxes will come. But that was withdrawn, equalization revenue.
Again, the infringement on the treaty is being opposed by jurisdictions. By any manner you try to collect tax, which is seen as an infringement upon treaty, they will come up with counter proposals, counter actions on such proposals, taxing proposals.
So if I was thinking, say it was like pillar 1 and pillar 2 is crawling actually, nothing can be done. So do they enjoy that so-called tax holiday digital economy till something comes up globally?
Don't know. I'm not too sure about that because European countries have now started coming up again with digital tax. They're reinforcing that.
Yes,
so we'll see how it develops in the Indian context. I cannot comment at this point of time that how it develops. No, certainly not. It's not going to be a zero tax situation for them. That is absolutely not going to.
Vidit, you have something to say.
So BAPS basically the pillar 1 and pillar 2 now that after Mr. Trump's assertion, pillar 2 of course now maybe as Honorable Revenue Finance Secretary also said, probably we have to rethink our pillar 2. Yeah. Of course, many countries like Singapore, etc., they've already made their legal changes and they are planning to revisit those. But in India, so pillar 2, which was only live after pillar 1 has already collapsed, which I understand. Okay. Still be brought that pillar 1, something like pillar 1 we had a significant economic presence in India and we tried to tax on source. Certainly from non-treaty countries, because treaty countries, you can't tax that also. So there are limited things. But still, as a crybaby, I am always a crybaby and I'll continue to be that because I'm from industry. So still, that SCP clause, Of course, there's a good clarification that now the sourcing from India has been taken out. But as far as supplying from outside India, again, that 2 crore limit continues to be there. And even if you are importing physical goods from outside, there's no income accumulating in India. You go outside, you place orders there, there's a supply. And then you say, no, Baba, we have to withhold tax in India because there is something called SCP here. Okay. And they say, why? I have nothing to do. You break business. Okay. And then, okay, they say, okay, let me tax you also. But then how much to tax? So I still don't have rules. So what is the profit attribution rule to India if I'm importing coal from something as a country with which I'm not and don't have treaty? So that's why there's no permanent establishment issue comes. And SCP is triggered because my import is more than 2 crores. Still I'm in limbo.
SCP change in this budget was a very notable, though very limited.
But the acquisition side, okay, procurement is okay.
Country, but it's bothering us a lot, sir. So because you have given a clarity कि अगर तुम माल खरीदने सर्विस खरीदने आकर ले जा रहे हो तो there will be no
अभी बराबर है वो लेकिन उल्टा साइड अभी भी है.
Very big relief, very big relief.
Yes, so but some clarification on the other side also. When you are procuring goods from outside India, of course, see what happens. Most of them are covered under treaties. Most of them are covered under treaties. But what remains is also a pain point.
So on the same analogy, yes.
Yeah, and more importantly, see, the SAP rules have been in place for quite some time. But there is a lack of clarity what is attribution. Because if you have a business connection, then the profit attributable to activities in India. When there is an SAP, what exactly? Because this entire transaction has happened outside India. Because this is in limbo. Its compliance is like, some of the companies are taking for granted for that.
Two responses on that. First, it is not a recent problem. Yes. It has been existing since forever, I suppose. Second, the problem is related to only non-treaty countries. So the gamut of the problem is smaller. Wherever treaty is there, treaty overrides. Nothing is attributed unless there is a physical presence. Third, yes, I acknowledge that profit attribution is not there at this point of time. We are not, but we are in an advanced process of settling the profit attribution rules. We'll come up with that, and that will sort of settle the problem. Yes, if you are selling coal in India, you need to pay some tax if you come from a non-treaty country on the basis of sale in India. Business connection is brought in. But how much tax you should pay, we should be able to tell. We are in an advanced stage of profit attribution rules. We'll come up with that. But I would request you, we are here for a budget discussion.
So these are the misses. Sir, you have not left. Sir, you have not left anything for budget discussion basically. So we have to discuss something more. Yeah. So
I have so many other questions which I can't ask. On the same analogy.
I liked Vinny's comment. Yeah. You have left nothing to be discussed on budget.
So we have to discuss something.
That's a big appreciation for my budget team.
Thank you so much. So very interesting, one of the facts and figures which I was working on personal income tax actually. 5.25 crore people don't pay zero taxes. Out of 8 crores, around 8 crores, 5.25 crores is zero taxes. From 5 to 10 lakhs, there are 1 crore 50 lakhs people are paying taxes. And 10 to 1 crore, again there are 1 crore people paying the taxes. So what I realized, the middle income have ballooned. From 5 lakhs to 1 crore, there are 2.5 crore people paying the taxes actually. So technically, if you reduce the first segment out, now we'll further go out of it, then only again we go back to 1.5 to 2% people are actually paying the taxes cash, actually. And so my thought was that, you can validate that, was it because they were ballooning of income of the middle class? Was there ballooning of other income like stock market, real estate, other thing happened? Third, is it because of AIS, something like that forced you have no choice but to declare the income correctly? Is that the reason for ballooning? Does it throw more light also?
I don't understand exactly what you mean by ballooning. Yes, personal incomes have increased. The people returning incomes have increased over the rates. And certainly it is because of sharing of information. There is no doubt there is a positive correlation between 2011 and 2024. If you see, our Rule 114E has expanded a lot. We have been sharing a lot of information related to all transactions. As Sir mentioned, that trusting the taxpayer with a voluntary compliance, that is the focus of the government. We do not intrude, we do not intend to intrude, we'll just share information. Whatever we have, we share information. If you see the e-verification scheme, it actually says that, we'll share everything. and you come up with whatever you want. That is why the updated return, as it was mentioned, has been extended to 4 years. Whatever information we get, whenever we get, we give it to you. If you are okay with it, file a return, pay tax, end of the matter. Have a non-litigated solution. Yes, incomes will certainly rise.
Vinit, you always...
Yeah, so you have, basically you missed something, sir. Let me compliment on that. So, personal income tax, when you talk about, you know, what is actually revised estimate is more than the budget estimate for on personal income tax front. And despite giving this 1 lakh crore on this exemption, this year budget estimate is 14.38 lakh crores, which is much more than what is the actual collection of this year's for 12.57 lakh crores. So basically that ballooning concept is coming and information sharing is really helping.
So I believe that exactly what you mentioned, sir, that this is AIS information being tracked. Now you have to file a returns looking that. You just can't run away. The system will pick it up actually. One of the reasons is there's a prosperity coming up, but I only get worried about the number of people paying the taxes. You go back to 2% now basically again who are paying the taxes. That's the only thing which bothers. Does this country of this size have only 2% people paying the taxes, taxable income?
I think
Yes.
what Revenue Secretary has also said, it's a matter of reciprocity. So the department, reciprocity. So the department is reposing the trust into the taxpayer and they expect the honesty, and that honesty is coming back in terms of the collection in the corporate taxes. So this is where we have seen this 1 lakh crore coming in terms of this tax benefit to the middle income groups.
In fact, I will just add, we will be quite happy if we are not to reopen the cases. We don't want to do that. We want SSCs to voluntarily declare their income so that we are not forced to reopen any case. We will be quite happy with that.
I guess basically on the lighter side, basically, if you remember, we have all grown in this taxation system. When there was an exemption limit of 1,80,000, there used to be many returns of 1,75,000. Okay, when it was extended to 5 lakhs, there is a vast class of people who used to file 4,85,000. So actually this is a trap. It's a 12 lakh exemption, you will find a lot of returns on 1170. Next year per force, they have to go beyond 12. Okay, so again that number will increase, don't worry about that.
So let me just shift to the budget, sir. Finally. I think in IFC, one of the provisions which you have amended is basically give a relaxation of deemed dividend for a foreign parent. Why that was limited only to a foreign parent? Because there are Indian corporates which are setting up a treasury operation in India, and that has been used as investing into the other subsidiaries, which could have an implication for an Indian corporate also. So Indian corporate, if set up an IFC unit, and the IFC unit is giving a loan to a subsidiary of an Indian corporate, a similar benefit could be granted to them as well.
IFSCA, from its very constitution presently, is trying to bring businesses which is outside India to the jurisdiction of IFSCA. That is the focus of IFSCA. And they had come up with this demand that there are treasury centers. For example, Volkswagen is running its treasury center in Netherlands or somewhere, and those treasury centers can move to India if this deemed dividend issue can be resolved. So we provided a window for them in the same manner as it is available for a listed company here, because between a listed company and a shareholder, the deemed dividend provision does not operate. So to that extent, it is sort of similar. Yes, it is not exactly alike, I acknowledge that. We can examine, if it comes to us, that whether the same benefit can actually be extended to maybe sometime next year. We didn't get a chance to examine that broader request. Perhaps you did not have this food on the table with reference to IFSCA. Once you have it, you will come up with the request. We will certainly examine it. It's a fair request. I do not deny that.
But one more on the budget only. This concept of TP block is a remarkable step. Again, the way everybody understood initially the request for being representation is like all the 3 years coming together and you take one assessment of all the 3 years. The way the law has been presented as of now is just that it will be done for the first year and it will be replicated in the second and the third year. Globally, if we see, the authorities do consider 3 years together to determine the arm length, not only 1 year, but combining all the 3 years. That is one part. Second, is there a thought process of aligning the direct tax transfer pricing with the custom transfer pricing. But what we have seen, there is a conflict amongst these authorities, and sometimes there are challenges that from a custom transfer pricing, it's a similar concept, and we have seen globally, there are one authorities dealing with both the transfer pricing.
I'll answer the second question first. Customs transfer pricing and income tax transfer pricing are actually mutually opposing, because they...
That is the challenge.
That is the challenge. So how so much ever you might try to align the two, they will never be aligned, because east is east and west is west, and never the twain shall meet. That is how it goes. So I do not see a direct alignment on that issue. On the second part which you said, transfer pricing, we've tried to bring in a block here. It is a first attempt, and the first attempt is basically as easy as we can. Because if you see TP assessments, if you've been associated with them, they take a long time in the sense 1 year for the assessing officer, 1 year for the TP, and then 2 months for the assessing officer. So by the time the TPO passes an order, 2 financial years are already concluded.
Yes.
So we are just trying to use this timeline, asking the assessee to identify similar transactions, that these transactions will also be mentioned in the TP order as a similar transaction, and whatever the ALP is determined for the first Y1, that will apply to Y2 and Y3. That is the simplest process as I view it. It should work. We'll come out with prescribed rules on basically similarity, when the options have to be given, whether they have to be given for Y1 separately, Y2 separately. That also we'll come up with a prescription. We'll take inputs from stakeholders. Let us see how this runs. I think it will run properly. Second year and third year are not going to be detailed TP examinations. It is basically on the concept of similarity. The corporate guarantee for Y1 will apply to Y2 and Y3. That is how it will pan out. And a specific proviso in subsection 1 has also been provided, that even if a reference is made, it will deem to be not a reference on that issue. So that also puts comfort in the minds of the taxpayer that we are actually focusing on certainty, as I mentioned in my previous question, that let there be certainty, let there be lesser intrusion from the taxpayer side by the department. So that is what we are trying. Let us see how it operates.
Atul, you also had some more questions to ask? You did all that. So, sir, one wish list basically for me to ask my colleague, Vineet, which you believe, which you're expecting the government should have brought in the budget, which has not come? From the industry point of view, let's take from the industry point of view.
Yeah. No, manufacturing is always my demand, because it has already been there, and of course, one is this tonnage tax is fantastic. The tonnage tax which has been extended to the domestic inland waterways, and actually it's a forward thinking that yes, there's a lot of thrust on inward waterways now. So this policy should work actually. 206C, that's a good move that has done away with that TCS of 0.1%, because till now we used to fight with our customers who will deduct tax or with withhold tax, and that's why I had given a standing instruction: don't compare, let them deduct, you also withhold. Okay, so of course it was a double blocking of taxes, but still, I mean, if you ask me, why 194Q also continues in the Act is slightly baffling, because ultimately it's commercial transaction, purchase transactions, right? And now all such transactions, like if you have, what is asking for that? First of all, you should be having a turnover of 10 crores, right? And your purchases should be more than 50 lakhs, right? So ultimately these transactions, both transactions mean that both the persons are registered for GST, right? Though all these transactions are above board, they are all the GST registered, and all the GST information is being passed on to the income tax department. So this 0.1%, now it is not for, certainly not for recording the transaction, it's more to collect the revenue, probably the same philosophy, pay when you earn. Right now 0.1% in a trading transaction, one can debate whether it's high, low, or should be there or not be there, because there's, of course, it has been introduced now in 197 that you can go for a lower deduction, but how many lower deduction certificates you will get? Because you are dealing with so many customers. So probably it's an irritating, I'll not say that it's wrong, but it's slightly irritating and could have been done away with just to have trust on the trade.
Should I answer?
Yes, sir. Yes, sir.
I'll just narrate an anecdote or a joke as we. एक आदमी खरबूजा लेने गया शॉप पर, तो ही स्टार्टेड हैगलिंग. उसने कहा कितने का है, कह रहा 5 रुपए का है. नहीं 5 तो बहुत ज़्यादा है. उसने कहा 4 का ले लो. नहीं 4 भी बहुत ज़्यादा है. उसने कहा 1 का ले लो. उसने कहा नहीं 1 भी ज़्यादा है. उसने कहा चल तू फ्री ले ले. द पर्सन सेड मैं तो 2 ले लेता हूँ. So that is absolutely what Vineet is suggesting. All along they had argued tooth and nail कि दो जगह TCS और TDS लग जाता है, doubling होती है, etc. etc. So many representations on that. So we did away with the TCS. So now he wants the second Kharbuja because you got it.
I told now. Obviously, I told. So basically these are minor. As I told, these are minor irritants because ultimately it increases the compliance burden. Nothing else. Of course, maybe some blockage, but yes.
I will open to the house actually. Questions, answers. We can take 3 questions. Yes, please raise your hand. Introduce yourself. Surprisingly, we know the budget so well. We know it.
Sir, can I, Raman sir, just one question. Going back to the whole discussion on manufacturing, and I agree with you that the sunset date was 31st March 24, right? And now, and I also agree with you entirely that a tax rate cannot be the only reason why some non-resident would set up a manufacturing facility in India. I fully agree with you. And there have been n number of case studies on this. We have had backward area deductions, etc. But nothing has worked till the time you have the entire paraphernalia there. Now, sir, interestingly, and why not interestingly, but importantly, in this budget, the government has come up with a national manufacturing mission and an export mission, which is a very different thought process as compared to the earlier thinking on manufacturing, where the government is saying, possibly, I think on the similar lines like an IFSC, that as a mission mode we will go, and they have identified those areas like lithium batteries, etc., in the whole Make in India program. So my thought here is, a question to you is, sir, that fine, 115 BAAB is gone, okay, because sunset was this. And that was limited only to newly set up companies who set up a manufacturing. Can we not, as a part of the manufacturing mission itself, bring in a new provision which is not limited only to new companies, but even existing companies which set up a new unit? And then why is it limited only to companies? Why not LLPs? Because, from a taxation standpoint, now I do understand a difference between the tax between a LLP and a company, but between a form of an organization, whether I am set up as a LLP or a company should not make a difference. Why the insistence that there should be a new company? So short point I'm saying is, sir, I agree that 115 BAAB is gone, but can we, as a part of the mission itself, relook at it, and also as a incentive on the tax side also, which the government is doing so much on PLI, etc., and the whole policy they brought in, also a trigger for a slightly lower tax for the manufacturing as a combined package incentive.
Just a simple answer on that. Fundamentally, manufacturing is capital intensive. You invest a lot. From that investment, maybe 20% portion comes as a revenue, and from that revenue, about 15% comes as a profit, less than 15%. For profit, you are taxing 22 or 15%. So 7% of 15% of 20% of the 100 invested. Just see. So it ends up less than 1% of the total capital investment. That is the tax benefit you are drawing. The government is actually rather incentivizing on the investment side through PLI, and there are so many things where incentives are far greater than this. The basic purpose of having a tax incentive is being done away with due to this effect only, because the government wants to give direct benefit for the purpose of assets or investment. A direct help, direct subsidy is always better and more efficient. We get to know whether it has benefit or not. A tax benefit is an uncertain benefit. If you don't have that profit, then that benefit doesn't go anywhere. And we will be anticipating maybe we have revenue lost, but actually it is not lost also. So removing that uncertainty, focusing on a direct benefit in place of tax incentives has been the philosophy of the government. So I think that is a better area PLI has worked. You see how sectors have actually boomed due to PLI. So that is the basic philosophy. I think it is correct. We don't need a further incentive from the tax side.
I think very well analyzed, sir. We never thought that analysis. Very well analyzed. Last questions, please.
Can I take one?
Yes.
So I'll just take one more question and then. Sir, we have made representations earlier also on this issue, and we would like to, because we have a big SHM membership sitting over here, number of people have been requesting us to make a representation on this, and we have done that as well. So we want to have it from the horse's mouth directly, that the anomaly between the tax rate on a private limited company and an LLP. This has been represented, and I have read multiple times whether from Bombay Chartered Accountant Society or FICCI or CII, or everybody has this on their agenda that this should be aligned. So that we put this issue on rest forever, what is the logic behind, or what is the thought process of the legislation that, okay, we don't want to do this, and this is the reason, so that we also don't repetitively come back and again, and we can tell our membership also, okay, this is the logic behind it.
Actually, the answer is very clear. So many times I have answered it, I am answering it again. Dividend distributed by a private limited company is taxed in the hands of recipients. Firm के केस में या LLP के केस में share of partnership is not being taxed. If you want an equivalent rate, हम वो provide कर देते हैं, equivalent partner के हाथ में tax कर लेते हैं. आप बताइए, representation दीजिए, हम certainly लाएंगे.
सर ये थॉट आई हुई मत खरबूजा हो जाएगा.
We can actually just give.
This basic difference is so apparent. So I think this question should not arise.
I had the opportunity to discuss with Raman sir this earlier also, but now we put this, and I understand this because the dividend rate is the anomaly. So we put this issue on rest now for our members that ये नहीं हो सकता.
Thank you. Let me end this session with a very positive.
One more request here. So basically, as I started, in fact, off the mic, I was talking to sir that, sir, this budget you left nothing to discuss. And in fact, a lot more to discuss after the new bill comes, because probably that will have a more, because a lot of demands are there, probably they might be being addressed in the new bill, we don't know. So in fact, and I told him, sir, हम जो भी बात करेंगे वो फूफी वाली बात हो जाएगी अभी आज की तारीख में तो. But there is something, sir, which is an industry pain point again. And in fact, I have been votary for that for last 8-9 years regarding these appeal effects. So when we start, we appeal to first appeal or go to second appeal. Fine, we get orders, whatever procedure delays are there. But when we win, certainly win that case, and after the appeal effects are not given, law was changed in between, an incremental penal rate of interest was introduced. But still, sir, there should be a study that actually are they being given or not. In fact, personally, if you ask me, sir, as a corporate house, I am seeing it very, routinely we are seeing that appeal effects are not being given. So I think another push from board is required for that. It's a procedural thing, it's not a legal thing.
Already push has come. Raman will explain that.
Again, I suggest next week you should go to the portal.
Okay, that's all.
I thank you in advance, sir.
Go to the portal and try to find.
I think we'll have to end it. You have a question?
I had one.
This is the last one, please. No more.
There is a pain that is, पुराना पेन है, उसके लिए पूछना चाहता हूँ. उसका लॉजिक समझ में नहीं आया था आज तक. I am an Indian citizen who has been saving from his tax-paid money and has been investing into conservative bonds, etc., getting some 6-7%, believing that I will be a senior citizen in some time and I will be able to draw out of that money और मेरा पैसा जो है वो वक्त के साथ में इन्फ्लेशन के साथ में कम से कम उसकी वैल्यू प्रिजर्व हो रही है थ्रू इंडेक्सेशन बेनिफिट। अब वो लास्ट ईयर इंडेक्सेशन बेनिफिट सडनली ख़त्म करके the government wanted a pound of flesh out of that inflation also. Now there were a lot of explanations last year also, I could not understand that. अब वो पुराना पेन अभी भी निकल करके आ गया आपने जब पूछा तो मैं लॉजिक नहीं समझ पा रहा हूँ कि मैं इतने सालों से बचा रहा हूँ 6-7% के बॉन्ड्स के अंदर लगा करके कि हाँ भी मेरी वैल्यू ऑफ द मनी बच रही है, इंडेक्सेशन बेनिफिट तो जस्टिफाइड है, वो तो होना ही चाहिए, उसके बियॉन्ड जो भी आता है उसके ऊपर आप टैक्स ले लो। अब वो इन्फ्लेशन के ऊपर भी टैक्स लग रहा है, इट इज़ समथिंग दैट इज़ पेनिंग मी, तो उसका लॉजिक समझ में नहीं आया। आप लॉजिक समझा दोगे तो शायद मेरा पेन कुछ कम हो जाए।
आपकी डिमांड कम है शायद, बिकॉज अगर आपकी ये डिमांड रहे कि बॉन्ड्स पे मुझे 12.5% टैक्स होता है और इन्फ्लेशन का लॉस हो जाता है, तो आप एफडी पे क्यों नहीं मांग रहे यही बेनिफिट? एफडी पे जो आपको इंटरेस्ट मिलता है on the maturity of FD, that is taxed at what percent? At your slab rate, which may be 30%, I presume.
So I would have actually asked that. The simplicity would have been कि आप 1 साल या 2 साल के बाद में चाहे बॉन्ड से चाहे एफडी से किसी से भी जो इनकम होती है उसको इंडेक्सेशन करके उसके ऊपर जो भी है उस पर लगा दो।
आप इंडेक्सेशन चाह ही क्यों रहे हैं? जब इनकम है तो आपकी इनकम रेट पे टैक्स होना चाहिए। आपको तो ये समझना चाहिए मैं फिर भी लोअर रेट पे टैक्स कर रहा हूँ आपको।
वो जो पैसा मैंने बचा करके सेव किया है दैट इज आउट ऑफ माय टैक्स पेड मनी, आई हैव ऑलरेडी पेड टैक्सेस ऑन दैट।
उस पे टैक्स नहीं ले रहा हूँ। जस्ट कम बैक, आई विल कम बैक ऑन दैट। आई एम नॉट टेकिंग टैक्स ऑन दैट अमाउंट अगेन, बी वेरी क्लियर अबाउट दैट। आई एम टेकिंग द tax on the interest accrued on that amount, on your tax paid amount which you have invested in an FD or a bond. When you transfer, I charge you tax on that additional amount. I do not charge you tax on the principal amount.
वैल्यू प्रिजर्वेशन की बात कर रहा हूँ, जो मेरा पैसा बचा है
वो तो आपको अभी क्या, हम लोग इंडेक्सेशन के जमाने में 1961 के बाद से जी रहे हैं, उससे पहले नहीं होता था, बाद में भी नहीं था। फ्रेंकली सी लेट्स बी रीजनेबल ऑन दैट। सी वी हैव एक्रीशन ऑफ इनकम. Normally we should have paid on normal tax rate, but because of this capital, they have already given that earlier it was 10%, 12.5%. Let's be reasonable on that. Okay, but then sir, that brings to me another question that income tax paid पे उस पर tax लगाने वाला सर foreign remittance वाला है सर. That's again a pain point for 20% TCS. We should board should rethink on that.
Yeah, we raised that limit also.
But it's still just 20%, sir. The money is already tax paid. Yeah.
So let me end this thing with first with a very positive note. It has been a thumbs up budget. I think we saw all basically. There were so many covenants, and the most redemption number one had been for the personal income tax side. Since independence, never ever 1 lakh tax exemption benefit has been ever given. It goes up to from 25 to 30 lakhs, there's a 1,10,000, there's something like this. So this has been one, and adding such a big cash flow. I always used to say you used to get 5,000, 10,000 benefit, and there used to be headlines. This time you got a lakh, never unprecedented happening, ever happened, giving an extra cash flow to the middle income people. And sir,
I will just add one thing. This budget is, of course, the part of this tax exemption is being highlighted everywhere. It has been discussed everywhere. But it's not just like that. We have got many, like ease of doing business. There are so many provisions we have provided, whether that is related to TDS, TCS, or even for filing of this appeal for penalty immunity. That earlier you used to get 1 month to the Joint Commissioner for disposing of the appeal or assessing officer. Now we have made it 3 months because 1 month was becoming too short to take a judicious decision. So we have tried this in this budget to provide certainty of taxation to the SSE as well as to our own officers also. Because this is our belief, until unless the tax officers are also get sufficient time and they are also certain about the provisions, this litigation will go on. So even the timeline for doing the block assessment has been rationalized. The time limit for exclusion of a stay of period when some proceeding is stayed by court, that has also been rationalized. On the side of SSEs, many ease of doing business has been done. So along with trust, ease of doing businesses and tax certainty, these all three are the pillars of the present budget.
So friends, just to end in a very positive note, and I will share some beautiful statistics. India was the 10th largest economy in the world in 2014. Now in 2025, it has become the 5th largest economy with a GDP of around $4 trillion. India is likely to replace Japan and Germany to become the 3rd largest economy in the decade. In 1991, I must remember, Indian economy was smaller than that of Paris and London in 1991. But today, Indian economy is bigger than the economy of France and UK. India has overtaken 5 major economies of the world: Canada, Russia, France, and India is among the only country in the world where the average GDP is coming around 6.5 to 7%. So India is the 3rd largest economy in the world in terms of PPP. For PPP, the multiplier is 3.3, which you use for US dollar, which comes to $14.5 trillion with this multiplier. I just want to share you this statistic. Thank you so much for hearing, for the patient hearing. Thank you so much, sir. As usual, always it's a pleasure having you.
Thank you to our esteemed guests. We want to thank Mr. Ram Chopra and Mr. Ramesh Nayan Parbat for coming here. Please give them a round of applause. I request all those on the stage to please gather for a group photograph. We will slip into a 10-minute break, and this is a break for you to, use the washroom, get yourself a cup of coffee. We have our next session coming up, and this is on the analysis of indirect tax related proposals. We'll start that at 1:15, so I request all of you to be back in your seats by 1:15. Direct tax related proposals very shortly. I request all of you to please settle down and take your seats and clear the aisles. As soon as our guests are here, we will start with the session, and your attentive listening will be appreciated because you will get a chance to ask your questions as well. Please settle down. We'll start shortly. Welcome back. I request everybody to please settle down and take your seats. We will now begin our session on the analysis of indirect tax related proposals. In the budget, the customs tariff structure has been rationalized, and we heard our esteemed speaker in the morning also talk about the reforms being carried out so that there is a push to growth. The rationalization of taxes will of course increase the ease of doing business. It will strengthen domestic manufacturing as well as encourage exports. So we're going to talk about the indirect tax related proposals now. Please put your hands together and welcome on stage our session chairperson, Mr. Vivek Ranjan, member Tax Policy, CBIC, Ministry of Finance. Please give a round of applause and welcome on stage Mr. Vivek Ranjan. Please welcome our session moderator, Mr. Sudipta Bhattacharjee, partner, Indirect Taxes, Khaitan and Co. Please welcome our panelist, Mr. Prateek Jain, Chair, National Council on Indirect Taxes, ASSOCHAM, and Mr. Himanshu Goyal, partner, TR Chadha and Co. LLP. I would request Mr. Prateek Jain to please welcome the session chairperson, Mr. Vivek Ranjan, member Tax Policy, CBIC, Ministry of Finance, with a plant. We are grateful to Mr. Ranjan for taking the time to come here. I will now hand it over to our session moderator, Mr. Sudipta Bhattacharjee, to steer this discussion.
Are the slides visible? This slide, okay. Yeah, it's there.
Very good afternoon to all of you, and welcome to the indirect tax session. What I'll do is I'll quickly take a few minutes to run through some of the key changes just to set the context, and then open the floor to our esteemed panelists. Let's start with customs. I think one of the most critical and significant amendments have happened in terms of finalization of provisional assessments. A timeline has been prescribed for a 2 + 1 year timeline has been prescribed. This, of course, in terms of context, I think most of us in this room are aware there continues to be massive delays, often decades long, in terms of finalization of provisional assessment, which hurts both, which hurts SSCs, which hurts the revenue also in terms of blockage. So to that extent, this is a welcome, amendment. Especially for cases where there are imports on the basis of claims for exemptions, free trade agreements, valuation, especially related party valuation cases, this should hopefully go a long way. The exceptions to this are in cases where final assessment cannot happen because information is being sought from someone abroad, appeal is pending on a similar matter, or interim stay has been granted, some specific direction has been given. So some of these exceptions are there. One hopes that, it will be implemented in the true facilitative spirit that it is meant for. There are some nuances which we will take up when we open it up for panel discussion. Voluntary revision of import and export entries. Now this again is a very, very significant development. A new section 18A is being proposed, which will allow importers or exporters to voluntarily revise the declarations they have made in the bills of entries for import and shipping bills for export. What it would mean is this revision will be treated as a self-assessment, which by itself will entitle an importer or an exporter to seek to file a refund. What this proposes to do is to overcome legislatively a Supreme Court decision from 2019 in the case of ITC Limited, which, with the greatest of respect, has been doubted. Reservations have been expressed about the correctness of the judgment, which entailed that SSC would have to file an appeal before seeking a refund, would have to challenge its own self-assessment before seeking a refund. So that is sought to be legislatively overturned, which again, of course, is a welcome step, as hopefully it will curtail the assessment to refund that time limit. Currently, a lot of people go for amendment of bills of entries under section 149. There is no time limit for that. Often, SSCs have to approach High Court to speed things up or to get the relevant authority, the proper officer, to accept those things. Hopefully, some of these will be a thing of the past. Consequential changes have been made in sections 27, 28 in terms of prescribing limitation periods for filing refunds. The exceptions for this, like I said, it's a voluntary mechanism. So if this revision is happening subsequent to an audit, a summons, a seizure, a search, all of that is not allowed. If it is purely voluntary, based on a self-assessment, based on an internal audit or internal examination, that's when this is acceptable. There would, in some cases, be a scrutiny of such revisions, where based on risk parameters that will be prescribed, some of those cases will get picked up, and of course, if the proper officer does not agree, there will be reassessment and the consequences will follow. Other key changes, I think there has been extension of various time limits in the IGCR rules, customs import of goods at concession rate of duty. I will not go into the details, it's procedural, but it's a facilitative amendment. Settlement commission under customs and central excise will get replaced by a interim board. So clearly, settlement commission as a mechanism is on the way out. That roadmap was laid in the past budget itself. This is more aligned in that direction. No new application for settlement will be allowed post 1st April 2025, and the interim board will take up all the pending matters on a as-is where-is basis. The next one, not directly linked to customs, but critical from an international trade perspective, many of us are aware that the current model bilateral investment treaty that came in 2016 was a result of some of the bilateral disputes that we had lost internationally, and then it was felt that our model treaty probably was not balanced or not pro our national interest, it was revamped. Probably we went too far on the other side. There has been enough pushback internationally, especially when we are negotiating free trade agreements with EU or UK. Investor protection, investment protection is a major theme which has led to logjams. And probably that has prompted the Honorable FM announced in her budget speech that it will be revamped and hopefully a more balanced model treaty will be in place. And the last one on this is, of course, the multi-ministerial export promotion mission, which, of course, is very, very critical for the MSME sector, who are a growth engine, coupled with the fact that the MSME categorization itself is being expanded. This will be Ministry of Finance, Commerce, and MSME will pool in together to help in terms of export credit. But more importantly, I think to deal with non-tariff measures like CBAM or deforestation regulation, which are potentially can make our products very, very uncompetitive in the European market. Rate revisions, again, I think I'll not go into individual instances. Several rate revisions. Major theme, of course, is incentivize domestic production. EV and mobile, the lithium-ion batteries for EV and mobile telephone sector. I think there is a lot of push for that. Several goods exemptions have been announced. Simplification of the tariff slabs is another major theme. So you will see a large number of changes which may not have led to an effective rate change. So that, I think, is aligned with the theme of simplification. New tariff items for things like makhane, which featured several times in the speech. In terms of GST, I think one key thing was plugging the gap in ISD mechanism. This, to my mind, was an inadvertent omission earlier. ISD, as most of us know here, is becoming mandatory from 1st of April, but the law as it stands today captures intra-state input side services, which clearly could not have been the intent given the overall framework of GST. So I think that is being sought to be plugged. Definitions of local fund, etc. is being added to remove ambiguities when it comes to the scope of exemption of services to local authorities. Time of supply vis-a-vis supply of vouchers. This again is a consequential change because this whole concept of time of supply qua vouchers have become redundant. We have had a Karnataka High Court judgment which very clearly stated that these are not taxable, these are not goods. That has been accepted by the department by way of a circular dated 31st December. So I think it was sort of the last hurdle or the last residual thing that had to be done. That has happened. Now the very critical one in GST is in terms of the credit notes, and we will speak more on that. But just as a sort of headline, a new proviso is being introduced under Section 34, which says that unless the recipient has reversed its credit, the supplier's liability cannot be reduced. Now, this has, there was a circular earlier, this has been a dispute that has been ongoing for a while. How this will be implemented, I think we'll discuss a little more in detail in the panel discussion. Amendments have also happened in sections 38 and 39 to omit the term auto-generated. This looks hyper-technical, but effectively what it seeks to do is provide a legal validity to the invoice management system. Currently that is optional, but this will give legal backing because then there will be legal backing for generation of GSTR to be based on action taken by recipients on the IMS system. So this is intended to give legal backing to that. Pre-deposits, today what happens is when it is only a penalty that is being demanded, you don't have to pay a pre-deposit unless it's a case of movement of goods, seizure of goods, etc. So now that sort of, I don't know if it's fair to call it an anomaly, but that situation is being changed. 10% if it's only penalty, 10% at the first appeal, and additional 10% pre-deposit at the second appeal, that is being brought in. One could say that this is, alignment of sorts with what the situation in customs is. So that's one thing to remember. Track and trace mechanism, it's a new concept for us. It will be tech-driven, tech-heavy, targeted mostly towards evasion-prone commodities like tobacco, but of course the scope of that could be extended. We have a precedent of some sort of, this concept being there in Europe already. Let's see how we are able to implement this fully. aligning transactions vis-a-vis, in-bond sales that happen. Now, as we know, in-bond sales in customs bonded warehouses, before the customs clearance, they don't qualify as supply of goods or services. There has been some ambiguity whether this benefit extends to SEZs or FTWZs. Often a lot of in-bond sales happen in those cases. It's to my mind, a hyper-technical dispute, but the dispute or ambiguity was there. Thankfully, it is being sought to be removed by way of a retrospective amendment, a very taxpayer-friendly retrospective amendment to my mind, although no refund will be granted for any tax that was paid. But this clarity, of course, is welcome. Last but not the least is not so taxpayer-friendly retrospective amendment, which is the safari retreats, the overturning of the safari retreats judgment, a favorable judgment which led to a lot of cheer in the commercial real estate space in India. And I think I'll open up the panel discussion with that one. So in terms of maybe, sir, if you could help us. Okay, so I think the reason why I think we are keen to understand the safari retreat, the thought process behind that, there are two things that Supreme Court dealt with in safari retreat. If you look at section 17(5)(d), there are two sort of exceptions, or there are two scenarios where credit will be available, even if immovable property is being created. One, if the asset or the building being created qualifies as plant or machinery. Second is, if it can be established that the taxpayer is not getting the said asset or building constructed on his own account. Supreme Court interpreted both of these. On the first point, of course, plant or machinery, there is a lot of analysis, a lot of commentary on that. In essence, they say that there is a different phrase used, so plant or machinery has to be interpreted independently based on first principles, etc. And it reached a very favorable conclusion. The second part also has been very clearly dealt with in multiple paragraphs in the initial part of the judgment. What Supreme Court said in terms of on his own account is, if I am building something which is to be leased out, then clearly it is not on my own account. Now that logic could be extended. This case before Supreme Court was, of course, in the context of commercial real estate. It can even go on to a PPP project. If I am building a port or an airport or a LNG terminal on a PPP basis, if it is to be leased out, a concession is to be given, there can be many use cases of this particular interpretation. The proposed amendment deals with the first part, but not the second part. And I think that is where we would really be keen to understand, maybe from the government side, from the GST policy side, what was the thought process? Given that this, and this battle has manifested itself over the last 20 years in many forms. I think department has clearly been of the view that for immovable property, there should be a credit restriction. But if you could elaborate on that, we'll be grateful.
Yeah, good afternoon, everyone. Regarding this has been a complex issue, but let's understand the basic facts and then I will pass it on to my colleague from the GST policy wing. This phrase plant and/or machinery is used in 11 places in the Act. And I'm reading this from para 43 of the judgment. Out of 11, in one place it is plant and machinery. Again, the judgment itself says that in the draft model law that was circulated had actually plant and machinery. It was argued by learned ASG before the Supreme Court and also before the High Court that it was always plant and machinery. It was not even a drafting error, it is an inadvertent error. And therefore, this needs to be corrected. And Supreme Court also says that this judgment was delivered, I think, sometimes late last year. It says that order was passed by High Court 5 years back. At that time, why did the government not correct it, or GST Council for that matter? Department view at that point in time was that since we are going in appeal, let us wait for the judgment of the Supreme Court. But unfortunately, judgment went against us
and thereafter we had to take these steps to rectify the situation. That's part one. The last, point which is mentioned there, Supreme Court has already said that legislature is empowered to remove any vice which led to any particular judgment. In fact, in earlier some other points also I saw overruling the judgment. That's not the correct position. Supreme Court is saying that you can remove the lacuna, deficiency in the law, which was there, which led courts to interpret certain provisions in a certain manner. So you can always correct the vice or the basis of the judgment. That's within legislature power, it cannot be within judiciary power. So we are only trying to correct something which was at best an inadvertent error. It was not part of model law, and somehow it crept in, and we hoped perhaps that Supreme Court would understand, would perhaps take our view into account, but it has been ruled, so we have had to make these changes. I will not pass it on to Mr. R.P. Singh from GST Policy Wing to throw more light on it.
In addition to what Sir has said, the law itself was very clear from the day one, and it is in continuation of the provisions which were existing in Central Excise Act also. And nowhere the law has defined plant or machinery separately, or plant separately or machinery separately. There was through explanation, it was very clear that the plant and machinery has been defined in the law. So the intention was very clear. The issue is that after this honorable court judgment, the definition of plant and machinery, if we leave it to the field formation to interpret in their own way, in case-to-case basis, then it would have been a big problem for the trade. So that is why government thought, the GST Council thought that it is better to bring amendment retrospectively, so that there has to be some clarity that this is allowed and this is not allowed. So I think this amendment should be taken in this perspective, that to make everything crystal clear, let us have a retrospective amendment, and the law is very clear, and I think the trade, 99% of the trade is very clear from the day one that credit is not allowed in these situations.
Himanshu, Prateek, any thoughts?
I'll just make a couple of comments. First, I think from a policy standpoint, there's been a debate whether it should be allowed or not. There was a law review committee which was set up in 2018, which actually recommended that GST paid on construction should be allowed. Now, of course, GST Council, based on revenue consideration, decided not to give it. See, the question of intention, in any litigation which takes place between the taxpayer and government, there is always a question of intention which comes in. The question is who determines that intention. The law of the land says the Supreme Court determines what the intention is. They have gone into details to say intention is to give credit because plant or machinery is different from plant and machinery. Now, the government intention was always otherwise, because that's why you went for litigation. I think it's not the right practice to make a retrospective amendment. I think government also believes that. Whether it's the rarest of rare cases, etc., that can be debated. We were requesting the government that make the change prospectively. Yes, I completely agree with you, sir, that with what is plant, what is machinery would have been a matter of dispute. But any change which happens pursuant to a Supreme Court decision which is decided in favor of the taxpayer, which is a very reasoned judgment, is something which perhaps one should avoid. But going forward, I think there are two issues which is important, which are highlighted. One is what happens to an own account. The current interpretation is that if I'm constructing an asset for further leasing, it is not on my own account and hence credit should be allowed. Now that has not been clarified, it has been settled by Supreme Court. We don't know whether the Supreme Court review petition that the government has filed will be withdrawn or not. So that element needs some clarity. The second is from futuristic perspective. At what point in time GST Council will perhaps debate this and allow the credit on construction, because it impacts the commercial leasing, it impacts warehousing, increases the cost of infrastructure. That's more of a policy decision, more of a decision on revenue consideration. But Purely from a policy standpoint, we did some research as to what happens in other countries, and we could not find many other countries where this kind of restriction is there. So, to align it globally, I think we should attempt.
Also,
to
data
provide
centers.
that.
I think, given how we are going to invest in AI, we'll need more and more data centers. So I think for that also, it will. Himanshu, any?
Yeah, I completely agree what Prateek has said, and basically by doing this retrospective amendment, the sentiments of the industries get hurt, because a lot of planning, a lot of already the credit accumulation based on this judgment we were all anticipating for quite a long time now has already been done. So there are ripple effect which will happen on capitalization if we see from the income tax point of view, because already the credit must have been taken based on this judgment and looking for a positive outlook. Now again it has to be in a case like if we believe that this amendment is, since it is retrospective, what would be the ultimate fate in the Supreme Court, whether it could be retrospective or not, that's one element. Secondly, the review petition has already been filed. Now with this amendment, will that be withdrawn or not? That is another aspect. But the most important concept is like now the industry would have to look at from a cumulative point of view, not only from indirect tax, but from the direct tax point of view as well. Because the decapitalization or the credit which we have ideally being kept as a current asset, now we would have to simultaneously look for re-strategization whether we can capitalize or not. That is one part. One part more I would like to touch, I don't know how many of you belong to that industry, based on Anand Theatre, which have been marked in this Supreme Court judgment, the cinema halls and hotels have been carved out. And I think by the Honorable Supreme Court, while they were dealing with this issue, I think the comment which have been posted that since the matter does not relate to, that's why Anand Theatres, which is an income tax judgment, does not come in way with this judgment. But as far as I have seen the industry, the hotel industry specifically, if I talk about, has immense capital investment. And more or less saying whether it is on its own account or not, that's another aspect which has to be tested, which have, I think, not been discussed in the Supreme Court, because the case primarily was for the mall owners. And this is one more element that can be touched upon. I think the litigation path is still open for these industries to take it forward, because the capital intensive is huge, and primarily the CWIP which they create once the hotel get operation is tremendous. So that part also I think will see some light in future.
I think last word as a lawyer, which is there in the last bullet point on the slide. I believe Supreme Court interpreted the law as is, which creates a vested right, as Himanshu said, for credit for people who had taken a position aligned with the Supreme Court judgment. Whether retrospective amendment can take away this vested right, I think there are judgments both sides. I mean, I'll not go into that's a session on its own, but I think that's one area where we will see a lot of jurisprudence evolve in the coming days. Sure.
The question basically is, as you said, the draft law said that it is plant and machinery.
Supreme Court orders, para 43.
Para 43, plant and machinery, right?
No, yeah. Originally it was plant and machinery.
That was the draft.
It was an inadvertent error. It is admitted in Supreme Court order.
Correct. Now, sir, and this judgment, it has taken jurisprudence, drawn jurisprudence from income tax, as Himanshu also said, Anand Theatres, and then also Taj Mahal Hotels, which was the old decision, where they said why a hotel in a particular situation was construed as plant. Now, from an income tax standpoint, where there is a definition of tangible assets, they are saying plant, machinery. So, income tax has clearly said a plant is different than machinery. Secondly, definition of plant itself in section 43(4), it defines plant. So the question that I have is that if you know, from a common understanding standpoint and also from a legal standpoint, a plant, if it is different than machinery, then by saying that the condition has to be plant and machinery may never be satisfied, because if something is there, right? For example, let's say because, you know, I'm just taking income tax, it even says books are plants, we can say these books for a chartered accountant is plant because I use Income Tax Act. That is my plant because I read it and I interpret the law to give advice to the clients. Now, then the question will be, is it a machinery? Then we'll say it is not a machinery because machinery is a apparatus, whereas a plant could be different. So therefore, my short question is point which is coming to mind is, sir, that in the final law, if it came as plant or machinery, the legislature, was it not right in saying that it had to be plant or machinery? Because in various laws, plant has been distinguished from machinery. As I said in income tax, plant, comma, machinery.
So, So let me put the issue in perspective. Plant and machinery is defined and it excludes land and buildings and other civil structure. That is the issue. Every act has the freedom, latitude to define expression and coverage of that expression. So here plant and machinery is used in 10 places. It is defined in one place. Inadvertently it was mentioned as plant or machinery. So here, once we have amended, the plant and machinery definition as given in CGST Act will take precedence.
So, in addition to what sir has said, that every law has different requirements, right? So, for example, the telecom tower. My personal opinion might be different on whether the ITC should be available on the telecom tower or not. But the law is very clear that on telecom towers, the ITC is not allowed. And similarly, in the case of pipelines, where few industries are working exclusively in that sector, but the ITC is not allowed on that. So the law itself, as at the outset I have said, that the intention of the law was very clear. That is why there was a clear-cut definition in the CGST Act regarding plant and machinery, and there was nowhere we have clarified or defined plant or machinery separately.
In fact, he has made the point, if intention was to actually have this plant or machinery, we would have defined either plant or machinery or the expression plant and machinery. We didn't define, but we defined plant and machinery. So that again stresses or in a sense reinforces the point that it is an inadvertent error.
Okay, the next one I think is equally controversial, which is the credit notes amendment. I think I gave the headline, so effectively a new obligation is being cast on the supplier without the supplier technically having any ability. And we have seen an iteration of this dispute in GST when it comes, the ITC liability or the things to do for a recipient to avail ITC, right? We have a bunch of things that the courts have also now blessed. So Himanshu, maybe we'll start with you. Do you think this is this will be a very significant burden, or in light of the IMS system now being in place, are we reading too much into it? What are your thoughts?
Let me just answer this point maybe in two parts. One is pre-IMS and second is the post-IMS. Both has its own pros and cons. If we talk about the era which we are witnessing today, when we go for any assessments or any scrutiny, what is happening is the moment there is a credit note which has been parked in my GSTR1, the assessing officer asks for a counter claim that the credit have been reversed, then only the benefit of reversal of outward tax would be allowed. From an industry point of view, if that customer is with me and I am still continuing with them, it might be a possibility I can arrange that declaration from a CA or something like that, and the benefit can be given. But think from a perspective when that customer is not with me, I am not in touch with him, the assessment is happening under section 74 and it's a way back period, then the entire burden is on me as a supplier. And let me be very candid, the law does not give any mechanism and any right to me as a supplier where I can verify whether my customer has reversed that credit or not. So that's definitely an additional burden which is out of my control, but I have to bear the brunt. That is one perspective. Yes, definitely, based on these assessments which has happened in the past, industry have learned now, and this credit note has been used as a mechanism of great caution and whenever now we see as a credit note, when we do any compliance or advisory to the client, we definitely make him caution, get a counter affidavit sort of or certificate from your customer that we have reversed the credit. That is one aspect. Now, with the IMS coming into picture, and as Sudipta has already mentioned, a lot of amendments have happened in the returns just to make it legally valid. And this is the first time I would say the validity has been given and then the amendment will be done mandatory, because since the IMS is still in the optional phase. Now in IMS what is happening is that I can post my credit note, but that credit note has to be accepted by my supplier. If in case that credit note is rejected, then it adds up to my liability in the subsequent month. Again, that's a burden which has been coming. I can completely understand from the government point of view, government intent is very clear that we will only allow you the reversals till the time the chain gets completed. The complete circle has to come to an end, that reversal has to be done. But there are many cases what is happening right now by mistake, or maybe the original invoice has not been booked because of the year-end issues and all. The credit note has not been accepted. I have already paid the tax. Now if my customer is rejecting that credit note, what is my fault in that? What I have to do? And considering the IMS is still in the implementation phase, I think there is one more challenge in the API, when there are more than 500 invoices, I do not even come to know as of now which is credit note which has been rejected, and my liability gets added. So like if I have less than 500, then it flags that which is the credit note I have rejected. At least I can trace which is the customer who has rejected. But if it is more than 500, I am not even come to know. That's again a challenge which has been there. I think the API should release so that this limitation should also come to an end. But nowadays, like it is the tax function because of these IMS coming in. Anyways, not only for the credit note, if we extend even for the accept rejection matrix which have been envisaged in the IMS and can become mandatory anytime, it's no more only the tax function. It's a complete organization of the ops, marketing and the tax, because if the credit has not been coming in my PR and it has been reflecting in my IMS, whether I have to accept or reject tax alone cannot take that call. So all these kind of an integration has to happen, which industry would take its own time to get ready with these kind of a changes to come in.
Prateek, any?
See, I think we all understand the government perspective that as per the framework of the law, the buyer has to ensure that supplier has paid tax, and supplier has to ensure that buyer has reversed the tax if I am claiming the adjustment. Unfortunately, the mechanism was not there in the law. Even today, there is no mechanism for the buyer to ensure that supplier has paid tax. All I can ensure is there is invoices figuring in GSTR 1 and it's figuring in GSTR 2A or whatever, but I don't know whether on that invoice the tax has been paid or not. So that mechanism is not there. Fortunately, the mechanism now on this front has been now given by IMS. It's not mandatory as yet, but it will become mandatory soon. My only request, sir, would be to see that what would you want to do for the past period. I think if there is some kind of clarification which can be issued, that for the past period, I'll follow this mechanism, very in clear, either I accept that, okay, fine, the supplier has claimed the credit, I will not question the supplier. If that is not an acceptable situation, some clear guidelines as to how do we handle the past period. That's the only request, but for future it is now settled through IMS.
So regarding this reversal issue, I want to draw your attention on the similar situation arises when the post-sale discount matters. So CBIC through circular number probably 212 that was issued in the month of 26th June 2024. So we have given clarification that in those situations when since IMS facility is not available, till that time if credit is beyond 5 lakh rupees, then the certificate from chartered accountant can be submitted to the department saying that recipient has reversed the credit, right? So on the similar pattern, if we get the representation, then we can issue the clarification. That's not an issue for cases prior to this amendment, right? If the problem is still persists, because the situation is same in that also 15(3)(b) compliance. that recipient needs to reverse the credit. Right, so this is the one issue, and you can refer this circular number 212 issued on 26 June 2024. And regarding this IMS, we are aware about the problems because this is work in progress, and that is why it has been made optional right now. And a lot of iterations and a lot of other options will be given, but at the same time, I would request all the taxpayer to at least visit your portal and reject or click on the pending. Don't come for acceptance of the invoice or credit note, because that will be deemed, that will be considered deemed, because automatically it will be, if you don't do anything, then it will automatically accept everything and will populate in your 2B. So please come to your portal and take action, especially for rejection or to make it pending. Right, so that would actually sort out a lot of problems in future.
Right. I think for completeness, there is a matter pending before Delhi High Court where this particular requirement, the circular you mentioned, is sub judice. Of course, one of the argument there was no legal backing for some of these provisions, which I think now with these proposals that is being sought to brought in, as Himanshu said, it's a little strange that you first have the mechanism, then have the legal backing, but be that as it may, I think this will sort of play a role in how the Delhi High Court decides. In terms of the legal argument, again, the lawyer in me must highlight that as we are taking the argument in the context of input credit, that how can a recipient be made liable for supplier's default? The same argument in the context of supplier would also be applicable. Whether that argument works finally at a Supreme Court level, I think quite a few high courts have given judgments on this. Ultimately, it is clearly headed for Supreme Court. I think we'll see an iteration of that dispute in this case also. Maybe not for future with the IMS, etc. being in place, but for some of the past disputes where the stakes would be higher, I'm sure this will come up. I think 38, 39, I think we have already touched upon IMS. But Himanshu, if you want to talk a bit about what has been the experience on ground on IMS, any additional point you can.
I think the major issue which I've already talked about is more than 500 or less than 500 credit note, because of which we have not been able to track which credit note has been rejected, which I think Sir has mentioned. It's under implementation and the API will soon be released. That is one of the challenge. Otherwise, I think it's a welcoming step, at least for the harmonization and I think last December weekend, we already had a circular where they talk about freezing of 3B. 3B will be freezed and whatever changes you want to do, either in outward supply, then it has to be we have to do in 1A, or in 3B, before generating 2B, we can see the change. And ultimately, the intent, I think, from the departmental point of view, is very clear that they don't want any reconciliations to happen on a later point of time, because we are ready with the reconciliations the moment 2A, 3B or any of these kind of a notice is there. The ideology, maybe it will take its own sweet time to achieve, that is that whatever credit has been taken by avail reverse mechanism and now we have the IMS, it should ideally tally with your books of account and no sort of year-end adjustment or 30th September adjustment sort of then should be there.
So, in addition to what he has raised the flag, especially regarding the IMS, I want to inform you that there are a lot of things are going on, especially in the IMS, to make the life of taxpayers very easy. And so far, the experience of GST and the department is very good. And if you face any problem, because our helplines are working, and if any issue remains in, especially with IMS, then please raise the tickets. And as per our reports, that's so far no ticket is pending, because immediate resolution is being provided by GST. So, and especially like in case of amendments or in cancellation, there is some thinking is going on that right now within 24 hours you can cancel the invoice as well as the e-way bill, right? So this was a deliberate linking because it might prone to misuse also if we extend this timeline. But we are figuring out that how to give some other option to modify or amend de-invoice. So maybe in future, you will find out this feature also in the IMS.
Right. So switching gears to customs, I mentioned the time limit for finalization of provisional assessments. Of course, it's a very significant move, but I'm rather curious about the timeline of 2 + 1 year. How have we arrived at it? And the reason for that is, if we look at whatever guidance exists today, I mean, the finalization of provisional assessment regulation of 2018, that talks about a 2 + 1 month time limit, right? The predecessor to that, the CBSE manual of 15, they spoke about a 6 months time limit. I mean, I get it that, we are sort of trying to have some sort of a timeline when there are many instances of decade-long lingering provisional assessments. But we just wanted to understand the thought process behind the 2 + 1 year time limit.
Good afternoon, everyone. So, in Customs Act, different provisions carry a timeline, especially for adjudication and other things. So, keeping here, there is a section called 28BB already, which is given a timeline for completion of the inquiry or investigation, which leads to notice. So, even that prescribes for 2 + 1. So, keeping adjudication as a time period where there is a need for some kind of inquiry and for completion of an adjudication, if at all there is a representation made. So we had kept that, this should be the time which can happen. So that's a...
Okay. And just a follow-up to that, what happens if it doesn't happen, right? I mean, how do we, and this is a recurring theme for many aspects in tax law, how do we fix accountability? Because as you know how courts interpret, they will say, okay, the law says shall conclude in 2 years + 1 year. But if there is no consequence of that, then it's merely recommendatory or directory, it is not mandatory. So how do we, given that the intent is facilitative, what are your thoughts on that?
I think we should wait. I think it should get completed because, even for the past period, we had said that the time period will start from the date of assent of a bill.
Right.
So, we are taking care of it. So, I believe if you wait for 3 years, most of that should get liquidated. Thank you.
Okay. So just, I think the slides are... So just for completeness, there was a Jharkhand High Court decision. This is of course for the pre-2018 period, where they said that 6 month is, has to be adhered to, and this thing was quashed. And the SLP has recently been dismissed by Supreme Court. So the only reason I bring it up is if there is no consequence, of course, going to court is one option, but for recurring transactions of provisional assessment, one wouldn't want to go to court. So, we'll look forward to that clarification, I guess. Voluntary revision of import and export, and I think expected impact, and Pratik and I, we were discussing about what does it mean, transfer pricing adjustments, we can leverage this particular method. So, Pratik, you want to start with that?
I think this is one of the most sort of important change in this budget. So a lot of cases what happens is that I have a year-end adjustment between the related parties. So let's say if Indian entity is buying at 100 and they have to keep 5 rupees as a profit at the end of the year, and later they realize that to keep 500 rupees as profit, my import price should have been 90 and not 100, or it should have been 110 and not 100. Then today what happens is that if it is 110, then you go and pay tax along with interest. Typically, amending the bill of entry is a pretty cumbersome exercise, but I do pay tax. But practically, if it becomes 90, then I don't get a refund. Now our understanding is that after this amendment comes into play, I can go and revise my bill of entries and make it 90, and I can claim a refund of that 10 rupees in my example. And of course, if it is 110, then I'll pay tax, custom duty along with interest. If that is really the interpretation, I think it's a great significant relaxation. It's aligned with what happens globally, and it will simplify the matter for large multinational corporations who have this year-end adjustments as part of their transfer pricing adjustment, which is in many cases approved by the transfer pricing authorities as well. So it does simplify the life for the importers and exporters.
So basic driver behind this policy change has been an ITC judgment of 2019, which said that in case you want to revise your self-assessed bill of entry or shipping bill, you need to go through the process of appeal, and that was proving to be cumbersome. So this only attempts to do away with the requirement of filing an appeal in case of either you want to pay additional amount or claim a refund. But timelines will apply as provided in section 27. I will now pass it on to.
Thank you, sir. I think this has been the intent. Intent is that, government is sensitive that the transactions which companies enter are complex, and sometimes it is not possible for companies to anticipate during import that these things could be factors which could lead to revision. So typically what we find is that people either go for appeal or try to amend it in the section 149, where section 149 has a bar saying that it should be based on the document which is already available. So keeping all these judgments and provisions in mind, the provision was added so that if there is a self-assessment, if there is no reassessment, he could always, there is no dispute between the party and the department, and if he wants to revise, he can always revise, and that would be treated as a refund, which means that he doesn't have to apply for refund again. The revision will be taken as a self-assessment, and if there is a refund, it will be deemed to be a refund application, and the refund would be processed.
So is it fair to understand that now, post this amendment, we'll have three options if I want to, one of course is this revision. The 149 remains unchanged, right? So the option of filing for an amendment under 149, and of course the appeal as envisaged in the ITC judgment. So all three options remain. Of course, I understand revision is an attractive option.
All three options will remain because there are certain, in certain cases, every section has a conditions attached to it.
Correct.
So accordingly, importers would be able to choose and do it.
Correct. So I think just for completeness for the audience, the amendment route, while it is being used, one, it comes with a catch that the documentary evidence that you rely upon for seeking that amendment has to be in place at the time of the relevant import or export. Only then you can seek this particular route. So revision, obviously, the scope will be wider. Another thing, and so maybe this could be considered before the final provision comes in. Currently for 149, there is no limitation period, right? There is no limitation period for you agreeing to our plea, and of course there is nothing subsequent either. So now, as a part of this set of amendments, explanation is being added to section 27 to bring in a 1 year limitation period. So there would genuinely be cases where the application for bill of entry amendment is pending for more than 1 year. So which will effectively take away my right of refund. So if, this could be considered. There are many cases. If you seek for data, I think you will find that. So if this could be considered, because in some of these pendency cases, the limitation period will kick in. And even if you allow the amendment, the effective relief will not be received by the SSE or by the importer SSE. So this, this is just a suggestion which could kindly be taken into account. And I think one point, the section only talks about interest. That, if I have to pay by way of a revision, there is a tax payment and there is an interest. It does not mention any penalty. The Honorable FM also mentioned in her speech that there will be no penalty. But if that aspect could be clarified, whether by way of a circular or, I don't know, in the amendment itself, because you know how prone to misinterpretation these things can be, as because I don't want to be in a scenario as an importer where I come forward, I voluntarily revise, and then I'm slapped with a penalty apart from the tax and interest. So I think that's, I think the intent is already there. If it could be clarified and amplified, I think that would be very helpful. And I think the last point before we break for lunch is, and sir, I asked you this question last year also in July, is there any hope for a customs amnesty scheme? And I think if you would want to throw light on that.
So basically, let us understand, customs is different from other direct and indirect taxes in many ways. One of the important distinguishing point is that we are implementing not only customs law, but a host of other provisions. I think that number runs into 50 or 100. Now those acts, I mean, by amnesty we will have to take care of those acts, or either exclude all of those acts altogether. So it would limit the scope to which amnesty scheme, if at all it is considered, will apply. Part 1. Part 2, amnesty scheme is inherently unfair to honest, genuine assessee. One should keep that also in mind. I mean, that's a general complaint that we have heard even in GST. So we should be aware of that fact also. We should not promote a culture of non-compliance and then there is a remedy subsequently becomes available. So I presume, and then there are provisions which in a sense take care of this. 18A is one. Other is 28 already has provision of non-payment of penalty in non-suppression cases and 25% in suppression cases. So there are provisions available which an assessee can avail and settle his liabilities.
Thank you. I think we have time for a couple of questions, I guess. So please.
My question is regarding the recent changes wherein the pre-deposit condition for penalty has been imposed. Initially, it was only with respect to the movement of goods, well, say about the e-way bills or that. Now it has been said that if I have to file an appeal, I'll have to deposit a 10% of penalty. The law has a provision wherein recently also in the court, one of the employee got a demand of penalty of more than 100 of crores, which was quashed by the court, stating that it is not leviable. However, let's take an example. If it has been ordered by the authority that the penalty is imposable, now if I'll have to file an appeal, I'll either have two options. I have to deposit the 10% amount or I'll have to go by writ. So don't you think that by imposing this condition, the only option the SSC or the person will avail is the writ option? So by this we'll be overburdening the courts, which are already so much overburdened, and most of the courts have also emphasized that we are becoming an initial option for the SSC to get a justice.
So basically this was a lacuna in I think 107 which said that, which prescribed 10% of the duty amount wherever demand involved duty plus interest and penalty. There was a lacuna that is sought to be addressed by doing this to address cases or so-called notices which involve only penalty. So that's the idea. There was a lacuna, otherwise department would have said that you pay 100% before you file an appeal. So it should be taken as a facilitative measure rather than a punitive measure.
And basically there was a missing link, because in 107 we have specified section 129 where the e-way bill, that penalty and all issues are being covered, but there was no mention of section 130 where the confiscation and other proceedings initiated under CGST Act. So to bridge that gap, we have removed the reference to section 129 specifically, and we have included all sort of penalties. They can be a 10% to deposit, simultaneously in 107 as well as in section 112, right? But at the same time, we are in the process to review the whole mechanism of e-way bill, where it has been reported by trade and a lot of other associations that on minor technical issues, the heavy penalty is being imposed by the field formation. So though we have repeatedly issued a lot of circulars to not to do that, but still some incidences are coming into our notice that on frivolous ground or maybe on some technical matters, the huge heavy penalty is being imposed. So we are working on it. So parallelly we are doing both, like to make the taxpayers' life easy.
Hi, panelists. Thank you for the insightful discussion. Mansi this side. I also have a connecting question on the pre-deposit to be made for penalty. So reading of the finance bill as is introduced indicates that there is no maximum amount mentioned for the payment of pre-deposit in case only penalty is involved. So is this an intended amendment or inadvertent omission?
No, come again. You are saying?
पेनल्टी का अगर प्री डिपॉजिट है तो कोई मैक्सिमम अमाउंट नहीं है. अगर मेरा टैक्स और इंटरेस्ट इन्वॉल्व है तो उसका मेरा प्री डिपॉजिट का मैक्सिमम अमाउंट इन्वॉल्व है, प्रिस्क्राइब्ड है जीएसटी लॉ में 25-50 crores.
Linkage probably can be made.
No, I think that maximum capping will be there. It can't be like unlimited.
Okay.
Sure.
Okay. Thank you.
So, in the case of revisions of bill of entry, like what Prateek was saying, that in case it is later understood that the value of the transaction has to be revised to 110 or 90, it was not clarified whether such cases where the more duty has to be paid or the duty has to be refunded, are those things also covered in this revision of bill of entry, or only some technical issues or the say HS code etc. is
See, if you come to know later that there are some taxes to be paid, you can always or you have some kind of a revision of the value also, it can be declared in the bill of entry as a revision. Of course, if you want to avail a refund, then the limitation period which is in the refund will apply, which is 1 year. So within that, you should apply. And based on the risk basis, it will be selected for scrutiny by an officer. Then it will be done.
Let me just clarify that it will not apply wherever audit, search, seizure, investigations have been taken up.
I think last question, yes.
Thank you for the insightful session, sir. Prateek, you just mentioned that we all have received notices of Section 16 to see taxes not being paid to the government. But on the GST portal, there is definitely something available which says the GSTR 1 and 3B liability comparison. So if I am able to verify that, and as a taxpayer I know that 100% of tax has been paid in 3B compared to R1, which had my invoice also, is that a substantial proof to give in litigations?
No, so my, again, short point is that I as a buyer can look at GSTR1 whether my invoice is figuring or not. I can also look at GSTR3B, the total amount has been paid or not, right?
Right.
But I don't know whether the total amount which has been paid, whether it includes only my invoice or others' invoice as well, because I don't have access to other invoices. So yes, on a broader level you can check, but the law doesn't say that if 3B is the liability has been paid in 3B, then you are absorbed. So on a case-to-case basis, the authorities can still proceed against me as a buyer, saying that, look, your invoice has not been paid. So all I'm saying is there has to be a mechanism for a buyer to ensure that supplier has paid tax with respect to my invoices. And that mechanism, to my mind, is not there in the law.
We should take those screenshots also, keep us litigation free or something like that. Would that help?
Sorry, say that again?
Taking those details that yes, 100% of tax has been paid, should we keep those records also for our suppliers?
I mean, of course we should, but at the end of the day, whether the record will be acceptable or not, right? Because you can only get that declaration, you can only get, yeah.
I think we'll close the session now. In case you have further questions, please speak to the speakers on a one-on-one basis. Please give a round of applause to our speakers on stage. We are grateful to our dignitaries for taking the time to come here. I request all of you to please gather for a group photograph. With this, we have come to the end of today's conference, where we have analyzed the direct and indirect tax proposals of the Union Budget 2025. I hope the deliberations today have brought about clarity on how these changes will be applied, and I'm sure your hard work and guidance can help move towards a trust-based framework. We'd like to thank our sponsors for their support. A big thank you to Nangia Anderson LLP, PwC, Khetan & Co., SW India, TRC and JSW. I request our speakers to please have lunch at the speakers' lounge please head to the lounge, and that is for our speakers alone. I request everybody else to join us for lunch.